gentlemen, and a very warm welcome to the 4th edition of CNBC-TV18 Banking Transformation Summit, presented by Nucleus Software. Over the last 4 years, this platform has brought together some of India's leading policymakers, banking and NBFC leaders, and Fintech innovators to examine the forces reshaping India's financial ecosystem. And what a transformation it has been. In the last decade, India's financial ecosystem has built unprecedented scale, digitized the customer journey, and expanded across to formal finance. Technology has fundamentally changed how India is banking, borrowing, lending, and paying, and doing business. But as we enter the next phase of this transformation, the conversation is evolving. It is no longer simply about how technology can transform banking. It is about how we do that responsibly. And that brings us to the theme of this year's summit, Scaling Bharat Banking with Responsible AI. As artificial intelligence becomes increasingly an integral part of the financial services, the opportunity, of course, is immense to making banking smarter and faster and more inclusive, more efficient. Through the course of this evening, we will look at this transformation from multiple perspectives, multiple lenses, from smarter and faster credit across Bharat to the next generation of India's fintech economy to intelligent banking systems and, of course, evolving NBFC landscape. We have an eminent lineup of leaders with us this evening. I can see all of you here. And we look forward to conversations that will help shape the roadmap for a world-class AI-powered financial ecosystem that can support Bharat's ambition and long-term growth. Ladies and gentlemen, to set the context for the conversations ahead and deliver the opening note, it is my pleasure to invite a leader who has been closely involved with the evolution of banking technology and the systems powering financial institutions in India and across the world. Put your hands together for Parag Bhise, CEO and Executive Director, Nucleus Software, as he takes the stage for the keynote address.
Thank you so much, Mukta. Good evening, everyone. Shri Shirish Chandra Murmu, Deputy Governor, Reserve Bank of India, Mr. M. Nagaraju, distinguished leaders from the banking and financial services community, esteemed policymakers, technology leaders, colleagues from CNBC TV18, ladies and gentlemen. Welcome to the 4th edition of Banking Transformation Summit. It is both a privilege and a responsibility to open this important dialogue. Over the previous 3 editions, this summit has brought together some of the most influential voices shaping India's banking journey. Each edition has reflected the priorities of its time. Today, however, we meet at a defining moment. The conversation is no longer about whether artificial intelligence will transform banking. The transformation has already begun. The more important questions before us are, what kind of transformation will we create? Who will benefit from it? And how will we ensure that intelligence is accompanied by responsibility? This is why the theme of this 4th edition, Scaling Bharat, Powering Progress with Responsible AI, is especially timely. For Bharat, scale is never merely a technology challenge. It is the challenge of serving a customer in a metropolitan city and an entrepreneur in a small town with the same speed, dignity, and reliability. It is about enabling an established enterprise to access sophisticated financial services while ensuring that first-time borrower is not excluded because their financial history is limited. It is about empowering MSMEs, farmers, women entrepreneurs, and emerging businesses with access to formal credit without compromise the prudence, resilience, and stability on which our financial system is built. India has shown the world that technology can broaden access and create impact at extraordinary scale. The next chapter must ensure that artificial intelligence strengthens this progress rather than unintentionally creating new forms of exclusion. Because in banking, an algorithm does not simply guarantee result. It can influence whether a family receives a home loan, whether small business obtains working capital, whether a suspicious transaction is stopped, or whether a customer receives help at the moment they need it the most. Responsible AI, therefore, cannot be treated as an additional compliance layer introduced after a solution has been developed. It must be embedded into the design of the institution, into its data, processes, platform, governance, and even culture. An AI-enabled financial institution must be able to answer some fundamental questions. Is the decision explainable? Is the data reliable and appropriately protected? Is the outcome fair? Is there clear accountability? Can a human intervene when the situation demands judgment or empathy? And most importantly, does the technology improve the customer's experience and financial well-being? At Nucleus Software, our experience of working alongside financial institutions across diverse markets has reinforced one enduring lesson: that technology creates lasting value only when innovation and trust advance together. Technology has a critical role to play in enabling responsible AI, but its success depends on an enterprise-wide commitment bringing together boards, regulators, business leaders, risk teams, product teams, and technology partners. We must move beyond isolated experiments and build institution-wide capabilities, strong data foundations, explainable models, continuous monitoring, secure architecture, and clear governance. Responsibility is not a constraint on innovation. It is what gives innovation the confidence to scale and the credibility to endure. Trust will determine how confidently customers embrace AI-enabled financial services, and governments will determine how safely institutions deploy them. And collaboration between regulators, banks, financial institutions, and technology providers will determine how meaningfully AI contributes to Bharat's progress. The future of banking will not be defined by the institution that deploy the AI most. It will be defined by those that apply it with greatest clarity of purpose. Institutions that use intelligence to understand customers more, not intrude upon them. To expand access without reinforcing disadvantage, to anticipate risk and not conceal it. To augment human judgment while preserving accountability. And to create experiences that are not only digital, but also dependable, inclusive, and humane. As we begin today's conversation, I encourage all of us to look beyond individual technologies and ask a larger question. What financial system do we want AI to build us, to help us build? A system that is faster, certainly, but also safer, more intelligent, but also more transparent, more personalized, but also more respectful, more scalable, but never at the cost of stability or trust. On behalf of Nucleus Software, I extend my sincere gratitude to Sri Shirish Chandra Murmu, to Mr. M. Nagaraju, and to all of us for honoring this summit with your presence and perspective. Let us help define a shared commitment to scale Bharat with intelligence, to power progress with inclusion, and to build the future of finance on the enduring foundation of trust. Thank you, and I wish you all a very meaningful and thought-provoking summit. Thank you very much.
Thank you, Mr. Bise, for setting the tone for the evening. And now, ladies and gentlemen, we turn our attention to one of the most important conversations shaping the future of financial services. As AI becomes increasingly integral to banking, the focus is shifting from adoption to responsible deployment. The opportunity is immense, but so is the responsibility to ensure that innovation is supported by strong governance, resilience, and customer trust. To share his perspective on building a responsible and resilient banking ecosystem, please join me in welcoming Shri Shirish Chandra Murmu, Deputy Governor, Reserve Bank of India, for his keynote address.
Distinguished guests, colleagues from banking and financial industry, ladies and gentlemen, namaskar, and very good afternoon to all of you. It is a privilege to address this distinguished gathering at the 4th edition of CNBC-TV18 Banking Transformation Summit. This year's theme captures, I think, exactly the right subjects for our times. Scaling Bharat, banking with responsible AI. And it gives us a timely opportunity to consider how responsible innovation, governance, prudence, and trust might define the next era of Indian banking. Let me begin with a story. One I return to wherever I think about what it means for banking to serve a country like ours. More than 3 decades ago, NABARD, with support of the Reserve Bank, launched a modest pilot linking about 500 self-help groups to the formal banking system. Their members had little conventional collateral, no credit history, and barely any documentation of income. And yet, their repayment capacity turned out to be strong, borne out month after month in the performance of those microloans. This savings-led microfinance model has now become the largest coordinated financial inclusion program in the world, covering almost 100 million households in the country, with more than 84% of the groups being exclusively women groups. The program has provided much-needed push to empowerment of women in the country. The point I wish to draw from this is not that the program succeeded, though it did remarkably. It is that the information relevant to lending was never actually absent. It was there all along in the discipline of savings, in the rhythm of regular meetings, in how closely members knew one another's circumstances, and in mutual accountability. What formal finance lacked was not the information, but a means of using it. And even today, in far more sophisticated markets, economic capacity often exists quietly, waiting for formal systems to develop the means to recognize it. And today, the means have arrived in the form of artificial intelligence. The question before us is how well and how responsibly we choose to use it. 4 days ago, from the rampart of the Red Fort, the Prime Minister spoke of training 1 crore young Indians in artificial intelligence within the year, so that India leads rather than follows in this field. I read that as a statement of intent and exhort you to ensure that innovation is rapid, at the same time accompanied by robust safeguards, applied with judgment, and underpinned by accountability. That, in essence, frames the 3 themes I want to speak on this afternoon: growth and capacity, intelligence and prudence, and trust and responsibility. With responsible AI adoption, which the Governor spoke of so lucidly at the last FIVAC last week. Let me turn to my first theme, growth and capacity. Let me start with where we stand. India's banking system today is well capitalized with a capital to risk-weighted assets ratio of 17.7%. It is profitable, with profit after tax exceeding 4 lakh crore. And it is healthy, with gross non-performing assets down to 1.8%. Stress test suggests that the system is well placed to absorb adverse shocks. Why does this matter? Because this strength is not an end in itself. It is the capacity that allows the system to support a larger and more complex economy. And here I would enter a caution. The contribution of banking to growth should not be measured only by expansion of aggregate credit or by the size of balance sheets. It must also be judged by whom finance actually reaches, whether rising consumer expectations are met, and how banks support the wider economic activity. On this count, there is a real progress to report. The Financial Inclusion Index rose to 70 in March 2026, up from 67 a year earlier, an improvement driven largely by usage rather than by mere access. Inclusion acquires real economic value only when consumers can understand the financial choices before them, manage their finances, appreciate the risk involved, choose credit and investment products suited to their needs, and know their rights and responsibilities. The Reserve Bank, for its part, continues to advance this agenda through the National Strategy for Financial Inclusion and the National Strategy for Financial Education. Financial inclusion remains, I believe, one of the India's remarkable achievements. Its next phase must deepen digital inclusion while ensuring that those who need assistance or other modes of access are not left behind. AI has a meaningful role to play here, helping the system recognize capability wherever it is expressed differently across language, location, livelihood, gender, and channel, and using the data prudently to make financial services more accessible. Consumer expectations, of course, are not uniform. A younger, digitally confident customer in a rapidly growing economy such as ours may prize speed, convenience, and real-time information. An older customer or one less at ease with technology may value assisted access, personal interaction, and reassurance on security. A retail customer may want simplicity and predictability. A small business may need timely credit, flexible servicing, and products built around uneven cash flows. Banking, in other words, must scale across channels and across forms of engagement. Growth also brings greater variety and greater complexity in products, technology, in delivery arrangements. A single deposit or loan relationship today may involve digital onboarding, consent-based data sharing, automated and increasingly model-driven assessment, partnerships with other banks, non-banks or fintechs, and servicing through apps or third-party providers. These arrangements widen reach and convenience considerably, but they also demand clarity. Clarity about who is responsible for product suitability, for the use of data, for service quality, and for continuity across the entire delivery chain. As banks grow, as their reach, their transaction volumes, and their delivery arrangements expand, their capacity must keep pace. Systems that perform well at today's volume may behave quite differently at tomorrow's scale, and that calls for timely upgrades in technology, in processes, in oversight, all of which innovation can help deliver. Banks should focus, in particular, on the function critical to their resilience and on those that matter most directly to their customers. Resilience, I would argue, should be built into design of growth, not bolted on after the expansion has already happened. And this requires people as much as requires technology. Institutions need people capable of understanding new systems, of challenging models rather than simply trusting them, of overseeing external providers, and of connecting technological change to financial and conduct outcomes. As machines take over more of the routine tasks, what becomes indispensable is human judgment, validating a model, assessing its outcome, and stopping it when it begins to go rogue. And this shift requires institutions to reskill and to grow their capability. Let me turn to my second theme, intelligence and prudence. Growth of this kind, capacity that keeps pace, that reaches wider, that serves better, is, in substance, not merely a growth of bank's balance sheet. It is the emergence of stronger and more capable financial system, one that truly supports customers and the economy. And this is precisely where intelligence comes into play. Like growth, intelligence has wider connotation than artificial intelligence alone. I would think of it as at 4 levels which are symbiotic in nature. First, analytical intelligence of data, models, and technology, where AI certainly belongs. Second, human intelligence of experience, knowledge, and judgment. Third, governance intelligence, the ability of boards and senior management to oversee an institution wisely. And fourth, collective intelligence, which emerges at the level of system when information is pulled across banks. The value lies less in any one of these than in how well they are combined. Let me offer a slightly different perspective on credit growth because the numbers are telling a more complicated story. In 2022-23, 52% of fresh businesses entered the formal credit system. By 2025-26, the figure had fallen to 42%. Even as outstanding commercial credit grew by 14% over the year. This did not happen for want of information. Lenders today have access to rich data and materially stronger analytical capability than at any point before. It points to something more structural, that our data and our technology may be getting better at serving those the system already understands, faster than they are developing the capacity to understand those it has never served. This is not a new problem in economic thought. In 1970, George Akerlof showed how information asymmetry can produce adverse selection and shrink a market below what the underlying economic opportunity would justify. Extend that insight to credit. Where a lender genuinely lacks a reliable information about a borrower, the absence of information should not, by itself, be mistaken for adverse information. Treating we don't know as though it meant we know it's bad, leads to a credit being denied where it need not be. This is precisely where banks must put their technological capability to work. So there is that intelligence. So where is that intelligence to come from? Traditional lending leaned heavily on collateral, financial statements, and credit bureau history. That world has expanded considerably. Cash flows, GST filings, utility payments, e-commerce records, mobile usage, agricultural and geospatial data. These alternative data offers a genuine opportunity to bring credit invisible into the formal system, and AI can help close that gap. The challenge lies in transforming conventional systems so that they can interpret information that does not arrive in readily usable form. An audio recording in which a borrower describes the purpose of a loan and the revenue of her business in the language she is most comfortable with, an image of a crop, an inventory or a physical asset, weather patterns that shape seasonal cash flows. Captured with consent, tested for reliability and bias, and used responsibly, this can become evidence that strengthens human judgment. Much is made, and rightly so, of the productivity these technologies promise. Work that once consumed hours of skilled attention, reconciliation of records, summarizing a credit file, answering a routine query can now be compressed into minutes, releasing capacity for judgment-intensive work that only people can do. But I would ask that we be careful how we measure that gain. Productivity in banking is not merely output per employee or the cost-income ratio. It is whether the same institution with the same resources reaches a borrower it could not reach before, resolves a grievance that would earlier have remained pending, prices risk more accurately. If AI compresses costs without widening reach or improving customers' experience, we shall have automated the existing system rather than improved it. A more consequential use is pattern recognition. AI can read not only structured indicators, but audit observations, incident narratives, customer complaints, and system logs together, identifying connections that may not be visible to single function, and so help a bank act as emerging weakness in fraud, conduct, operations, or cyber risk before it becomes a disruption. As adoption of AI increases, banks must retain the judgment, the capability, and the alternative arrangements needed to intervene when systems fail or behave in a ways that were not anticipated. The ability to remain resilient in such circumstances is itself a critical organizational capability, form of intelligence. The ability to recognize, adapt, and respond when the unexpected occurs. AI can improve consistency, cut processing time, surface patterns that conventional analysis might miss. But its correctness depends on the information it relies on and the condition in which the information is applied. Performance that looks impressive in familiar territory may not carry over into new customer segments, new activities, or changed economic conditions. A model that performs well overall can still fail a small but already vulnerable group. Intelligence, therefore, demands clarity about what a technology delivers, what it leaves out, and whether its output fits the decision at hand. This is where human judgment remains indispensable. And that involvement is meaningful only when the people responsible understand the basis of the decision and hold the authority to intervene. Because a review conducted after the material choices have been made can undo neither those choices nor the harm they may have caused. A resilient bank is, at its heart, the outcome of intelligent governance. The board and the top management carry the ultimate accountability for the decisions taken, for the assumptions those decisions rest on, and for the consequences that follow. Governance intelligence lies in their ability to convert the information flowing in from across the institution into a coherent strategic view. Its purpose is not to pull governance into day-to-day execution. It is to see where institutional capability or risk appetite is falling behind changing needs, and where separate weaknesses, each individually manageable, might combine into something larger. AI can help assemble this institution-wide view, but care must be taken not to introduce in the process a centralized algorithmic risk. We are all part of deeply interconnected financial system, and that interconnected connection delivers real efficiency gains, but it cuts both ways. Where several institutions lean on the same data source, the same models, and the same technology providers, or the same infrastructure, a single error or disruption can affect them altogether. Prudence in such a world requires effective challenge, limits on undue concentration, and credible alternatives. The intelligence needed here cannot be assembled within any one institution. It has to be pooled. The same logic applies to digital fraud, which moves through multiple accounts, devices, and intermediaries at once. When risk becomes collective, the intelligence marshaled against it must become collective too. MuleHunter.ai and the Digital Payments Intelligence Platform are the Reserve Bank's answer to exactly this challenge, drawing together dispersed signals with the help of AI so that detection comes earlier and the response is better coordinated. Let me turn to my last theme, trust and responsibility. As banking becomes even more deeply woven into daily economic life, trust is what allows customers to use financial services without examining every institution and every process standing behind them. A street vendor accepts a digital payment with the same confidence as a large retailer. Families transfer money across the length of the country without even tracing the chain the payment travels through. In 2025-26 alone, the Unified Payments Interface, that is UPI, processed over 24,000 crore transactions, worth close to 314 lakh crore. Not one of these transactions may have involved a conscious assessment by the customer of the institutions standing behind it. Technology enables the transaction and confidence sustains its use. That confidence, in the end, rests on the trust customers place in banks. And trust does not come from prudential soundness or regulatory oversight alone. It depends equally on fair conduct and on quality of customers' actual experience. A customer's financial position or her ability to repay does not by itself establish that a particular product, amount, or tenor is suitable for her. Formal consent has a limited value when the important terms are hard to understand, or when the material consequences become apparent only later. Responsible conduct, therefore, must be the foundation on which every product rests, and that responsibility must extend across the product's entire life, not merely to the point of sale. The key fact statement mandated by Reserve Bank is one such instrument. Its purpose is to support an informed choice by the customer, not simply to tick a disclosure box. Trust is also weighed on another scale. Transparency of bank's processes and the fairness with which a customer's grievances is handled. A loan rejection, a lower rate of interest paid, or the withdrawal of a service should rest on considered reasoning, and that reasoning should be communicated clearly to the customer. The role of AI must be to help the bank to see, explain, and correct an error, not to make rejection faster or more persuasive. Two things follow from this. First, a customer dealing with an automated system is entitled to know that this is what they are dealing with. Disclosure of that fact is not a courtesy. It is the basis on which a customer decides how much weight to place on what they are told and what to do next. Second, wherever a decision materially affects a customer, a loan declined, a limit reduced, an account restricted, a claim denied, there must be a route to a person with the authority to look again. Machine may reach the decision. A person must own it. It is a bank if a bank cannot say who that person is, it has not deployed a model, it has delegated its accountability. And every complaint a customer files against a decision of the bank deserves a timely and fair response, one that genuinely looks into customers' concern. Bank's internal ombudsman mechanism provides an additional layer of review before any rejection is communicated to the customer. Its value lies not only in offering the bank extra cover, but in serving as a second check to make sure that a decision adverse to the customer is, in fact, correct and impartial. Technology is reshaping consumer expectations in another way too. Not every credit appraisal, KYC update, or grievance can be resolved at the speed of payment. But what customers do expect, and reasonably so, is to be told what is required of them, why a process is taking time, where it currently stands, and what happens next. Clear communications is very often as important to trust as speed itself. The same holds true during service disruptions. Restoring a system technically is not enough if customer remains uncertain about their balances, about the status of their transactions, or about their access to funds. In that moment, clear communication matters as much as an orderly technical recovery. So let me conclude by drawing these threads together into 5 principles that I believe should guide banking through the era now opening before us and as it supports India's transition to a a Viksit Bharat. Include to enhance capability. Expand the frontiers of financial inclusion and help build genuine financial capability alongside it. Measure progress not only by the number of accounts opened, but by how effectively they are used and whether customers have the information and confidence to make informed financial decisions. Adapt to change. Stay responsive to shifts in technology, consumer behavior, business models, and wider economy, so as to meet changing needs at scale. Build these skills ahead of the activity, not after it. Understand what you use. Know what a system does, where its limits and its vulnerabilities lie, and where accountability rests. That begins with a current inventory of every model and AI system in use, including those embedded in vendors' products. Enhance safeguards and deploy intelligence for resilience. Anticipate and contain cyber fraud and other emerging risks while protecting consumers and preserving market integrity. Test these systems adversely before deployment and again at regular intervals thereafter. Further, use intelligence proactively to anticipate the unexpected and preserve critical functions when disruptions occur. And lastly, explain what you decide. A decision that materially affects a customer should be capable of being understood, questioned, and where wrong, corrected. Wherever an error could cause material harm, a person must retain the authority to intervene. Thank you very much.
Thank you so much. Lata Venkatesh from CNBC-TV18 here for the fireside chat.
So as a journalist, I'm not artificial. Very tough to be artificial. Intelligence is not my forte, so I will stray away a little from artificial intelligence. This gathering of bankers and NBFCs have some very important questions for the Reserve Bank. One of them is this revolving credit draft that has come. You know, you'll say revolving credit should not be allowed to NBFCs, but you don't define revolving credit, you define actually term loans, saying that they shall issue term loans. So what exactly will be forbidden? Even loans against shares is not a term loan. Even loans, inventory funding is not a term loan. Supply chain funding is not term loan. So what is forbidden, sir?
I think most of you are aware, those who are practitioner NBFC. Actually, this is not a new regulation. It has been there all along. Okay. Revolving credit as such was not permitted even now for NBFCs. But what we are proposing in the draft is we are trying to bring more clarity. And so that's why the definition has been emphasized in the draft regulation. And with this, we feel it will help better compliance. That is the idea. But nevertheless, as you are aware, this is a draft only. Okay, we welcome any suggestion and any practical issues which the regulated entity might face. Those kind of feedback are welcome, And like I said, this is a draft only.
Okay. So can NBFCs assume that most of the activities that they now do, like loans against shares or loans against mutual fund units or inventory funding, all that will continue to be allowed? Since
Obviously. See, our regulation will not come on the way of any business activity. So that is very, very important for all of us. The idea is not to prevent anything. Idea is to do business in a certain way, keeping in mind the risks. So what we are trying to do is bringing more clarity. But as far as operation is concerned, I think it will not cause much problem.
okay. Now, to address what the bankers are always worried about, deposit growth. At the moment, because of the FCNR deposit flow, the worry about deposits has been postponed a bit, maybe by a year. By the way, sir, why was it stopped early? Any guess you can give us?
About what? About
Why was the FCNR deadline advanced?
See, I cannot give you exact answer to that, but I can only generalize my response, saying that, see, we have to respond to the situation. So there is nothing early or late. We have to be able to respond to the evolving situation. As you know, things are very dynamic. So what holds today may not be true tomorrow. Even 7, 8 days is a very long period given the kind of uncertainty around us. So coming back to your deposit growth, I don't think any banker is worried about deposit growth.
No, now because of FCNR, they are not.
No, I don't ever they are worried about, because that is where they start with their banking. And they are very comfortable with any sorts of challenge when it comes to deposits. And they are very, very, I think they are very, very capable of responding to the situation. And they have been able to do that. And right now, there is no such challenge. Whatever you are referring to, some time back, there was the difference between the credit growth and deposit growth was a little wider. But I think hopefully things are improving.
So as recently as April, there was a 6 percentage point difference. Deposits were like at 10% and credit was at 16, 17%. So it was a wide one. The FCNR from June 20th onwards has given the hope, and now it is a reality that deposits have really grown. So, you know, you all had that rule that you can give bulk deposits at different rates to a retailer, to a financial institution, depending on the runoff of the deposit. See, like that, should we expect more? Yeah, that was...
Yeah. No, what we have been trying of late is basically to bring down the frictions and to bring more flexibility and more operational flexibility for banks. Mm-hmm. So ultimately, these are the commercial decisions, how you raise deposits, how you price deposits. So what we have been doing of late is to give them more flexibility. Mm-hmm. So with that, I think bankers are well placed to basically, if you call it a challenge, to meet that kind of challenge.
Okay, we were hoping like that bulk deposit, more such steps of flexibility will come. I mean, I was just wanting to know if any more such steps will come.
No, as and when any new steps comes, like it is a part and parcel of our public consultation, so you will be fast to know it.
Okay, okay, sir. We always know it only from the website. You don't give away. Sir, coming to the MDR, is there any guess you can give us as to what will it be? Say 2,000 crores, 2,000 rupees as minimum. Will it be 2 crore merchants, people with sales above that? Any guesses as to where the threshold will come and when?
See, I will not hazard a guess, but it will come definitely now that what we hear. See, we are as much as we have got as much as information as you might be having in this area, because this is work in progress.
The rules will come from you or NPCI?
See, it will come from NPCI. it will come from NPCI, but we are part and parcel of the discussion, like we have been discussing. So government, RBI, and NPCI, we are discussing on this, but definitely directionally, you know, now that the enabling provision has come in a way. So it is going to come, and what shape and how the distribution, all these things, finer points have to be worked out.
Okay. So finally, there was a buzz. You know, one small finance bank has become a universal bank, but the other small finance banks still are like microfinance institutions. They don't seem to be scaling up. Any move to consolidate them, change regulations?
No such things.
Okay.
Yeah.
Okay. So a final question, since I'm a reporter, I cannot not ask that question. Will you postpone the decision on Tata Sons exemption because there is a lot of confusion? Or will you advance the decision?
You have been asking this question, I think, in every
For as long
policy.
As the exemption was applied.
We are giving the same answer only.
Okay. Thank you very much,
Thank
sir.
you.
Thank you very much for your indulgence. Very kind of you, sir.
Thank you, sir. Thank you, Lata. Thank you so much for sharing that candid conversation and perspectives. And now, ladies and gentlemen, we turn to a banking landscape that is being reshaped by changing customer behavior, evolving deposit and credit dynamics, the rapid expansion of digital payments, and the growing influence of AI. With the credit demand continuing to evolve, banks are also looking at newer ways to engage, to strengthen deposits, rethink the economics of digital transactions, and leverage technology, all while navigating the opportunities and risks that come with this transformation. To decode these changing contours of Indian banking, may I request Lata once again to please come back on stage. And joining her on her panel are, put your hands together for Ashwani Kumar Tiwari, Managing Director, State Bank of India. Rajiv Anand, Managing Director and CEO, IndusInd Bank. Ashok Chandra Sahab, Managing Director and CEO, Punjab National Bank. And Sanjay Agrawal, Managing Director and CEO, AU Small Finance Bank.
Mr. Tiwari, Mr. Chandra, Rajiv, and Mr. Agarwal, thank you very much for joining us at the Banking Summit. This is quite clearly a very, very important panel because we are in the contours of a changing banking system. The way in which people are saving has changed. More and more people have become investors. But before I come to that dreary question, just because of the changed notification we got a few days back, Mr. Tiwari, are you very angry with the Reserve Bank because they shut the FCNRB? Mr. Murmu has left. That's why I'm boldly asking you.
This is a recorded telecast event, so I would leave it at that.
No, but did it come as a surprise, and will that change your plans?
Not really, because we
Because
had
you're the biggest.
No, we had an internal target, and we are close to achieving that. So I don't think we were really too much perturbed by the stoppage. This was under discussion that if the flows are really strong, then maybe an early call can be taken, which is what he was alluding to, that's a dynamic situation. So for us, it has not made a material difference. We'll still achieve the target which we had set.
Okay, so what do you think may be the full amount by August 31st? There were about 17 days after the announcement of the advancing of the deadline. We did 52. You think the pace looks like we may hit 70? Because with each passing deadline, it seemed to pick speed.
Yeah, it might, because the flow has been really strong in the last 15 days and more. So therefore, the number you talk about may be achieved, but I'm really not sure about the pipeline with different banks. We know our number, but surely other banks, I can't hazard a guess.
Fair point, sir. Rajiv, do you think this makes for better margins for the banking system? Because this, steady deposit is now there with you all. And for some banks, it may be a little cheaper. I don't know how it is. But will FCNR be a reason for easier margins?
I think, one of the messages that we got when we met RBI was that we're doing this for the nation, and this is not really about, making more money.
Okay.
But let's work hard to, get the dollars in from a national perspective. But having said that, I think there is dispensations on CRR, there's dispensations on SLR, and also dispensations on the lending side from a PSL perspective.
Yes.
Put it all together, it makes a very compelling proposition for all banks.
Okay. Fair enough. Mr. Chandra, would you say that loan growth and margins can be helped? You've got more to lend. You've got a steady money, 3-year or 5-year, which you didn't have. Term deposits were not coming. So should we expect both loan growth and margins to help?
Yeah, to a great extent, definitely towards the deposit side. Definitely it is going to ease the cost of deposit, no doubt about it. Because one is that interest rate with what cost of deposit was coming. And second is the CRR, SLR exemption which has come. So definitely the cost of deposit because of this inflow which has come in the system, I think it will be reduced. Now, once that money has come, definitely it is going to be utilized for the lending purpose. So to that extent, I think credit growth is also going to happen in the system. So from both the angles, the deposit side and the lending side, definitely all the financial institutions are going to be benefited about that.
Sanjay, you want to add to that? You think if you started the year, you gave a guidance of some number, it can be increased by 1 or 2 percentage points because this is quite a bit, 70 billion if it is.
I think, Lata, this is all for big daddies, We being a bank, small finance bank, we were not playing this game at all.
You have become an adolescent now.
No, I know you asked this question to sir, but we didn't play this game at all because being an SFB, it was difficult for us to get the guarantees on board and all those things.
Sanjay, the ecosystem has more money.
I know the SBIs and the PNBs should grow more because of that money.
No, I mean...
I'll just add a couple of things. See, margin-wise, it's neutral. Because there is
neutral?
Neutral in the sense that there's a lesser margin on the deposit itself because what we are paying on there. But it is balanced, as Rajiv explained, by the CRR, SLR and PSL. The important thing is liquidity. So this is in turn replacing those high-cost bulk deposits and all. So overall, it should be good for the banking system.
No, it also makes you all more competitive vis-a-vis the bond market. Bond market is running away with the price of crude and the US yields. So that's why I was asking whether you're at a better position.
I think for us, what we are betting on is this, that SBIs will not raise money, more costly money, and indirectly, to help us, and so if big daddies are safe, they are having a lot of money, so the people like us will take rest and can do our business.
I know a few foreign banks are lending to a lot of other smaller banks, so...
But maybe not us, sir.
I'm missing a foreign banker here.
No, one important aspect, in fact, that also we should look into that. This entire activity has brought a lot of foreign investors into picture now. Now you have seen almost all the leading banks, public sector banks I'm talking about, they went to the overseas market, they have raised the dollar bond, they have raised the overseas lending. I think to that extent, that much exposure has gone to the world. And I have seen that a lot of foreign banks, they have shown a lot of interest in participating in that, whether it is the dollar bond or the overseas lending. So to that extent, the market has become very, very wide. And we were able to expose ourselves to the world platform now. I will talk about Punjab National Bank. For the last almost many years, 20 years, we had not gone to overseas to raise the fund.
What may you end up 31st August?
See, we had given the commitment and we were very firm in the very beginning, around 2 to 2.5 billion. And we are still holding to that position and we are going to cross that here.
Okay, and after that you will go for an OFCB?
Yeah, in fact, we have already initiated the process. We have already filed to the SEBI also that we are going to raise MTN, $500 million, and 500 plus 500 green shoe is also there. And that somewhere between 10th to 15th of September, we are going to do that. And we have already raised 1 billion foreign lending through the syndication. And that too, we went to the Taiwan market, where many Taiwanese bank, Japanese bank, and Korean bank, they participated. And very successfully, $1 billion we raised and plus 500 green shoe also. So to that extent, the market has become very wide. And all the public sector banks, we were able to expose our presence to showcase the Indian growth story. See, if the public sector banks are able to raise that much fund in the Indian market, it shows the resilience and the strength of the Indian economy.
Of course. No two ways about that. People were willing to take exposure to Indian banks. So the end amount will be much more than 70 billion if there are going to be OFCBs following. Will you all do more?
That, of course, was always the additional amount. So the ECBs and other things are being raised. And people have preponed that decision to take advantage of this window. So that obviously will be an additional number.
Okay. Rajiv, will you all also do that? Going to the global market?
There are three pieces within the FCNR puzzle, so to speak. One is the plain vanilla retail money. I think currently the rates that are being offered by all Indian banks is very attractive, and even for us, we're seeing a good inflow into plain vanilla retail money.
Attractive for the depositor.
As a depositor. Then there is leverage that we are providing through from our balance sheet, and obviously that has we've been able to get funding through through bilateral transactions. But Mr. Tiwari mentioned some foreign banks are lending. Yes, they have lent to us as well. And the third piece is where we are working with partner banks as well. So there is good traction on all three platforms, and our overall market share on the FCNRB is around 3%. And so therefore we think that we should be getting whatever that number is, we should get about 3% of that.
Okay, let me come to the other thing that has just hit us, the fact that banks now will be compensated somewhat for some UPI payments, P2M, as they say, payments to merchants. Rajiv, what is in your mind in terms of how much? Will it be 30 basis? It will be less than debit card, we were told. If it is as much as a debit card, what are your best guesses in terms of the split and the amount?
No, first let's split the transactions. P2P is out.
Yes.
P2M up to 2,000, 2,500 rupees, that's out.
They haven't said
right?
so,
and then,
but
so therefore it is really the higher value transactions that we could effectively get paid on. And I think if you look at the credit card business, the classic four-party model, there is an acquiring bank, there's an issuing bank, there's a customer in between, and there is a network. There the customer pays, and that income is split between the acquiring side, issuing side, and the network. We will come up with a model of a similar nature for that chunk of P2M that could potentially get paid. I mean, I think you don't want to kill the goose at the same angle as well, and so therefore that amount has to be. The good thing is that the habit formation has happened. That more and more transactions are going through UPI. That habit formation has happened. The ability of the merchant to absorb 15, 20, 25 basis points, I think certainly exists, because you have to also see it relative to the cost of cash.
Yeah.
It's not as if cash transactions are free.
No,
I mean, there is the risk of it sitting in the store. There is a cost by the time you deposit it in the branch, etc., etc. And so therefore, all merchants will look at it relative to that as well. So I would imagine 20, 25 basis points.
Okay, overall, it will be charged about 20,
that
25.
would be split between the acquiring, issuing, and the network.
The banks may get a third or half of it. How much is the system paying actually for it? I mean, either of you, since you all are the bigger banks, is the system paying 10,000 crores at the moment?
I think it is a substantial amount. And see, it is not like we are paying or we are reimbursing. It is basically the architecture and the infrastructure which the banks have created, that is the thing it is now.
So you think it will become a no profit, no loss for you all at least once the payment starts?
As of now, we are already doing it without any charging anything.
Now you're paying for it.
So we have already created the infrastructure. Let us wait and see. I think DG has also told that RBI, NPCI, and the government, I think all three are engaged in that particular activity. So let us wait and see that how it pans out and what is the final outcome it comes now. So I will be still holding to that position, that let it come from the other side now.
Sanjay, what are your thoughts? Do you think you can do creative things? One bank was saying, we can give, say, I as a parent am able to do UPI with the merchant. I can delegate some of it to my child. Do you think innovative products like that will come?
No, I think, first of all, I think it's a very welcoming move because something is being now started, from years, and we had our own cost, be it infra or recurring cost, we had to pay to our tech guys, So, and I started putting QR codes in 17, to the merchants, and they were not making any money out of it. So we actually wind down in 2021, right? But I think we should really start because we are not playing a game of POS now. POS is heavily done by big banks. So I think this is an opportunity where people like us, being a small finance bank, we should go merchant to merchant, put QR code. And I believe if the baseline is 2,000 because we are expecting that same line as a credit card using at QR codes, right? So I believe it's a game will be played again. And it should be a favor in bank, and if a bank plays their strategy well in terms of putting the infra first and then the QR codes, creating new innovative models or giving even credit lines to those merchants, it can play a holistic game.
Net, I feel would you say banks are in a better position today than they were even 3 months back?
Correct.
I mean, you are having this bhandar of FCNR flowing. I mean, there's more liquidity. And there is possibly, for the system, you benefit from the system.
Yes, of course.
And, probably some OPEX is going to be paid back.
Yes.
So is that a better position, better spreads than you envisaged a quarter ago?
But I think, Lata, banking is always like this, Some years they will give you back, some years they will take back, I have seen from last 10 years. So we should not become more happy about it. I think regulators always want to build a very resilient banking system. So, and of course, the entire ecosystem. So somehow, some days we'll be benefiting, or some days, it's all right. So
at the moment, I am told, I read through the minutes of the RBI, and it does look hawkish to me, more than what the statement was. So rate hike possible, sir?
So before answering this, I would suggest that one very simple solution which has been around for a long time, which will control all our costs on infra, is the UPI's wallet. Now, perhaps the NPCI should look at making a smaller value, let's say up to 100 rupees mandatory to the wallet, because that will really reduce the small value transactions. And that is something under discussion. If that gets done, I think this will make a far more difference than any MDR share which might come to any of the banks. On the rate hike, we have nothing to say. The Deputy Governor was here. You should have asked him.
So I think ultimately, for the work that is happening on payments, the fact that it is interoperable, etc., if you look at it across the world, Lata, somebody pays. Either the consumer pays or the merchant pays. And various countries have taken various models. You can load it at the consumer level, you can load it at the merchant level, but ultimately somebody needs to pay for it. And so therefore, the fact that we can then argue on what that MDR number should be, but I mean, if there is a transaction that is being put through, somebody needs to pay for it.
No, fair enough. That's what the governor said during the policy meeting as well. The person who takes the advantage pays, and therefore a little bit of it has to be shared by everyone. Let me come to the other question, which was the heart of this, contours of banking. Mr. Murmu laughed it away when I said that deposits have become hard to come by. As recently as April and May, deposit growth was in single digits. It was actually 9% as recently as March and April. It becomes 10 only April, and it is, inching towards 14, 15 only now. It may dissipate as soon as the FCNR flow ends. So what would your ask be? I mean, how do you structurally solve this problem of deposits growing slower than credit?
So you're right on the structural part. The shift from saving to investment has started happening, and it's gaining momentum. So I don't think there's going to be a go back to deposits. It's not going to be there. In fact, in the PSB conference which we had, this is one of the themes. And there's so many deliberations took place. All the numbers definitely point. I mean, we just look at the mutual fund number. I'm not even talking about stock market. From 2020 to 2025, the mutual fund AUM has tripled, 25 trillion to 82 trillion. And therefore, the deposit growth has slackened. There's no denying that fact. So what is to be done now? So my sense is that we have to now look at innovative solutions. It's no longer walk-in deposits, which we used to have, or this thing. So one thing is, I mean, some of the deliberations which we did, youth was, of course, one of the things. That today what happens is, while we may open some youngster's account, the parent will fund it or may under guardianship, and then subsequently we may give a scholarship or some later on a loan. After that, there's a break. Very few of us actually follow that journey through to the job and to the future and all. Now, such segments now, and somebody talked about the self-help group, Mr. Murmu talked about that. Now, again, we have only limited to that particular product of the loan and maybe whatever related deposits. We don't look at each individual and say that, okay, what is their journey here? So each of these segments, whether it is women or youth or entrepreneurs, we'll have to look at the whole journey, lifestyle journey. That's one. Secondly, on enterprises, today we are talking about ecosystem. But again, it cannot be just a loan product or an insurance product alongside. It has to be the full spectrum, including deposits. So deposits will be a byproduct of multiple things. Transaction banking, which private sector banks have done very, very well. Now all the PSBs, public sector banks, are also very strong, and any current account will be a derivative of transaction banking. It cannot be a standalone current account. That's very hard. So one is that we have to be more nuanced about all these things. Second is that while we'll do all this, clearly there is a case that we look at alternate funding mechanisms. So some of them have already started happening, case in point being the infrastructure bonds. Now, on the face of it, looks like 7%, whatever plus is a high rate for a 15-year period. But we have to remember that one, that we always had an asset liability mismatch issue. The average deposit tenors for 3 years, whereas the loans could be 10 years.
So infra bonds will go up, you're saying?
Infra bond is one instrument, which it's a very good instrument. So why not? Secondly, the other things are I'm not talking about 81, 82 bonds, but there are instruments which have been very sparingly used. Now banks are getting into CDs and CPs and all, but they've been there. NBFCs are very strong users. So that will be a short-term usage. Then we have the securitization. There are some challenges on the regulation side and etc., yield side. But clearly a 30 lakh crore of housing loan book sitting there.
It's not securitized.
It's not securitized. There's no cash available against that. Similarly, a vehicle loan book of almost 10 lakh crores. So huge amounts of bank books are available for securitization. I think this is a market which is going
There is no regulatory worry or ask.
No worry. There are some fine-tunings required, which we are now taking up. And then we have to look at the other available instruments. So I guess it's going to be a mix of targeted deposit taking and end-to-end life cycle management, then also on the alternate funding mechanisms which are there, and a whole mix of all this. It has to be hard work now. This problem is no longer easy that people will just come on their own and you just pay them a little higher interest and they will come. No, that time is gone.
Our parents saved entirely on term deposits. And we don't. We serve mutual funds. Out of time, sir, but any quick ask from the Reserve Bank on the deposit front? They are freed for bulk deposits. You'll have some freedom to
in fact,
charge.
In fact, that was already there in the system. The differentiated bulk deposit interest rates, already it was there. What RBI has done it that they have made it very transparent, and they have given a timeline that earlier what was happening, and now also it is happening, that bulk deposit rates throughout the day up to 12 o'clock, 1 p.m. also, every bank used to prescribe that, depending upon what is the inflow that is going to come. Now RBI what is asking is that by 10 o'clock you have to prescribe your bulk deposit rate. They are giving a cushion for another 10 minutes. So by 10:10, all the banks, they have to declare their bulk deposit rate, and throughout the day, whosoever comes within that bracket, that has to be given to that rate to that individual or the corporates.
Okay.
So basically, the transparency has come. In fact, the deposit side, what Mr. Tiwari was also mentioning, see, three things are required to be done in the system. One is, especially I'm talking about the public sector, because leading private sector banks, they have already in place the relationship manager concept or the wealth manager concept. But many of the public sector banks having millions of customers, but this wealth management concept, or to a great extent, the relationship manager concept, that is missing now. So now the time has come when the deposit is migrating towards the capital market. I think we should have a very, very strong system in place. So that is one thing which I think all the leading public sector banks, they have to do it. Second is the infra bond or the green bond. I think definitely that is one route we need to move upon. Okay. And instead of just harping on the deposit, that is one thing. Third aspect, again, after seeing the global market, there is a very good opportunity to raise the MTN and the dollar bond or the overseas lending. And all these things, I think they should supplement to the deposit side.
Fair enough, fair enough. I am being asked to wind up, so let me just end up with a rapid fire. All of you, one number. Rajiv, what do you think is the credit growth likelihood this year? Will it be better than this 18%?
We think that there'll be a little bit of a slowdown from here, so maybe somewhere between 16 to 18%.
Okay. Mr.
16% roughly.
No, the question to you was, will margins be better?
Oh, sorry.
Better. I'm only asking for monosyllables.
Margins will always be under pressure, and India anyway higher margins than many other countries. Oh, so I don't think margins are going to improve tremendously. Might be a small blip up, but longer run they'll be always come down.
Okay, Mr. Tiwari, sorry, Mr. Chandra, I want to ask you whether bad loans will climb up a bit. There is El Nino pressure, and there is higher raw material cost for SMEs. Many SMEs tell us packaging material is expensive, etc. So, is the best over?
No, I will not subscribe to that. It is more hyped, I will tell you.
Okay.
And
that's a monosyllabic. They are yelling at me.
No, it is basically you see the numbers, and numbers are speaking now. So you see the Q4 number or the Q1 number of this financial year.
Yours was good.
Not PNB I'm talking about. I'm talking about the banking in general, all public sector and private sector. Best SMA percentage and the best GNPA
so
and
no
net
danger
NPA.
of
As of now, no danger at all. And all of us are ready to meet all the challenges, even if it comes. See, we were talking about the El Nino, but so much rain has come to the different parts of the country.
Okay, I'm sorry,
so we need to be very positive about things now.
Same question to you. Slight uptick, possible?
Yeah, so I think I'm echoing Disa's view that this is one of the best time. And I strongly believe anything plus 16% is the number. Which
is the growth that you're looking at. Yeah. Thank you very much. You all leave us very optimistic. You're not complaining about deposits as much as perhaps the onlookers and the experts are complaining. Thank you very much, Rajiv, Mr. Tiwari, Mr. Chandra, and Sanjay.
Thank you. Thank you so much.
Thank you, Lata. Thank you, gentlemen. And that was how the next chapter of credit can combine technology, scale, speed with responsible lending. Now, moving forward, our next conversation takes the idea of responsible growth beyond technology to look at the larger ambition of India's financial sector. As India's economy expands and the financial system grows alongside it, the choices institutions make today will determine not only how quickly we grow, but how sustainably and responsibly we do so. For our fireside chat titled Strategic Ambitions, Banking on Responsible Growth, may I invite Shireen Bhan, Managing Editor, CNBC-TV18, to join us on stage. Joining her are two distinguished leaders who bring deep experience and perspective from across India's financial ecosystem. Ladies and gentlemen, put your hands together for KKM Mistry, Non-Executive Director, HDFC Bank, sir. And Mr. M. Nagaraju, former Secretary, Department of Financial Services. A very warm welcome to the gentlemen. And Shireen, the stage is all yours.
Good evening, ladies and gentlemen, and thank you so much to each one of you for being here with us at the CNBC-TV18 Banking Transformation Summit. This is the 4th edition, and it is my pleasure to welcome the former DFS Secretary, Mr. Nagaraju, and Mr. K.K. Mistry, who has, of course, been a very regular guest on the channel over the last 26 years. So truly appreciate both of you taking your time out to be with us here today. Mr. Nagaraju, let me start by asking you, since you now perhaps enjoy a little bit more freedom to speak now that you're out of government, sir. Let's start by talking about the big budget announcement, this high-level committee for banking that the finance minister spoke of to look at the roadmap for banking of the future. Now, we still don't have the constituents of this committee, and we still don't know what this committee is likely to deliberate on, what the exact terms of reference will be. But if I were to ask you, what would your wish list be? What would you like this committee to focus on? What do you think this committee needs to prioritize if we were to talk about securing India's banking future?
Thank you. Thank you for inviting me. I think the banking committee, in my personal view, now that I'm outside the government, I think we should look at how India could reach the goals of Viksit Bharat 2047. What kind of credit, how much credit will be required? What is the deposits? And also the current regulatory environment in relation to capital norms in the banks, and whether big banks, organic, inorganic growth, and the NBFC, the role of NBFCs, and also the financing of infrastructure and MSMEs. I hope, and of course, they should also take a look at it. Some of the legal issues in the banking, BR Act or the RBI Act, if there's anything to be done, so that the institutions are much more robust, much more ready to ensure that the country reaches 2047.
Well, that's a long list of things that you believe the committee needs to prioritize. Let's address the consolidation issue, sir, because when you were last speaking here at the Banking Transformation Summit, you joined us virtually from Delhi, but consolidation was hot. It was a hot button issue. It almost seemed like the government was on the verge of announcing next steps as far as the next round of banking consolidation was concerned. In fact, the finance minister at the SBI conclave also indicated that this was under active consideration. What happened?
I think you should ask the finance minister.
You were the secretary, so I'm asking you.
See, now I can't see, I can't divulge the what has the deliberations, honestly. But look, there are several options to that. The government has been very conscious of the need, necessity, and as also, while taking a decision, it also has to weigh the pros and cons of consolidation. So there are many things are worth discuss. Now, last 2 months I'm not aware. So I think you have to ask the finance minister, current DFS secretary.
But do you think that there is a pull back on consolidation?
No, there is no pull back on the consolidation. See, let me put it this way. If you look at it honestly, the banks, the growth cannot be higher than the GDP growth. Okay, there is a fundamental relation between the two. Now, if you want to match big banks, let's say, for example, in public sector banks, let's say SBI. SBI in the last 2 years, they are growing by about 10%. Means their business is almost about 95 lakh crore.
Yeah.
100 lakh crore. 10% means they're adding 10 lakh crore per year. Now, some of the smallest banks are less than 10 lakh crore. So what kind of benefit SBI, let's say, or any other big bank, will get it unless and without attracting so much attention from CNBC and others, a lot of employees, public, everybody. And also whether a bank, if merged with any big bank, is that culturally fit? And HR-wise fit? What are the benefits? I think that should be the primary objective in taking a decision.
So I'm reading between the lines there, sir. So it looks pretty clear at this point in time that consolidation is not a priority for the government. But I will leave that there. Mr. Mistry, let me address this issue with you. We just heard the Prime Minister from the ramparts of the Red Fort talk about the aspiration of ensuring that we see an Indian bank in the top 10 as far as, or the top 5 even, as far as the global banking pecking order is concerned. Consolidation doesn't necessarily seem to be the route or the answer to that. How do we break into the top 20 even? I mean, State Bank of India is currently at 28. How do we even break into the top 25?
To my mind, it's something which is possible. May not be in the next 1 year or 3 years or 5 years, but certainly if you have a vision beyond that, we should get there. Look, we are a very young country. So much of our population, such a large part of the population today is under 35, under 30. People don't have bank accounts. People are studying. People are working. Once they finish, they get a job. They start, they start earning. They start opening a bank account, and that's the way the banking industry in India is going to grow. So, and anything you look at in India is very underpenetrated. If you look at any financial service product in India, it's extremely underpenetrated. Mortgages, for example, are about, 12% of GDP. Total retail credit is somewhere a little under 20% of GDP. Now, if you look at these numbers globally, they are so much larger. So we will grow for sure, and what will contribute to the growth will be the demographics.
Mr. Mistry, as you rightly pointed out, that across different categories, we continue to be fairly underpenetrated. Now, if I were to ask you to chart out a growth map from where we find ourselves today for the financial services sector, forget banking particularly, but I'm saying for the financial services sector, include insurance, include mortgages, of course, banking, what would that roadmap have to encapsulate to be able to cater to India's growth rate today, but also the growing needs of the population going forward?
All right, so let me try to answer that. And then, so there is no dearth of capital. Capital is available in India. Manpower is available in India. Talent is there in India. We have the best of technology. And I have no doubt that with AI, we'll be able to do even better in the days, months, years to come. So there is really nothing that we lack. And there is really nothing that we really need. The credit environment is very benign. I can also tell you that when you talk of asset quality, the average Indian consumer is extremely honest. This is our experience over 40 years. People don't default. If there is some way they can make payment, they come and make payment. So we have all the right setting to go to a much higher level, which I'm sure we will.
Let me address with both of you what Uday Kotak told me in a conversation very recently. He said the days of lazy banking are over. And we just heard from the previous panel talking about deposit mobilization. And, we've heard regulators express concerns about the fact that money is going into the stock markets and it's not coming to banks by way of deposits. Mr. Nagaraju, if the days of lazy banking are over, what is the challenge today for India's banking sector? From a public sector point of view, what do you believe needs to be done?
Banking is never lazy. It's very, very active, very stimulating, and also very risk proof. Okay, not that. In fact, if you look at it, the PSB especially, at least I know, most of our PSB banks have been around the country, all around the country. Sectorally talking to people, finding out their needs, and then designing products, credit products, deposit products that actually suits their major customer base. That they have been doing it. And last year, because since I am there, last year most of our banks have come up with very innovative products for women, for MSMEs, for agriculture, and the startup, everybody. Now, for the one issue, one thing that, in fact, even, Bank of Maharashtra, their deposit is a little more than 50%, one of the highest in the country. Now, it is not lazy banking that has led them there. It is actually very active banking. Active banking. Similarly, the banks like the UBI or SBI, they are all very active getting it. So No, they're always never lazy.
Never lazy, but there's room for more agility. But, you know, speaking about addressing different cohorts and different constituencies, the challenge thrown by the finance minister to India's public sector banks is, are you Gen Z ready? Now, Mr. Nagaraju, what will Indian PSBs need to do to tap into the Gen Z customer?
See, the last 2 years, we have taken a number of steps to align our banking PSBs with Gen Z. Most of us have launched apps, including, you know, O, Bob, Punjab, including P&SB Bank. We have an app now. And most of the customers on the and as well as the Bob are Gen Z from Metro. And this is the way to reach them. We are already actually doing it. I think now they will intensify the efforts to bring in more Gen Z. The other report I saw this week was the Gen Z is the highest growth in the stock market. And what new entrants to the trade are the Gen Z. People are having a disposable income. So naturally, you need to talk to them so that they will be able to save in the banks, not in the mutual funds.
So come to the banking sector, and you need to sell that idea to Gen Z, and that's the challenge that the finance minister has thrown. But Mr. Mistry, you know, from the days of the masked borrower, and I remember you and I had this conversation, and you said that people were so embarrassed to come to HDFC for a home loan because they didn't want to be seen as taking a loan. You know, the sector has come a long, long way. But from your vantage point of having observed the journey so far, what do you believe the next set of big opportunities could be? What are the big mega trends that this industry needs to focus on?
I think the country has changed a lot, as you rightly said. People's habits have changed a lot. From being so shy to borrow money, people today are actually going and borrowing money to go on a holiday, something which was unheard of 10, 20 years ago. I just want to make one small point, which is when you talked about deposits not growing because the money is going to mutual funds and going to stock market. But ultimately, all the money comes back into the banking system. It may not be in the form of a granular deposit, or a granular savings account deposit, but it is in some other form. Its lendable value will be less, but the money will always remain in the banking system.
Yeah, and I think that's the point that the bankers have been making. But, you know, what we've seen over the last 12 months specifically, Mr. Mistry, is foreign direct investment. We've seen strategic deals happen in the sector, and we've seen significant amount of capital coming in as far as growth capital to the sector is concerned as well. Do you believe that that is likely to continue? Do you see more of that? Do you see more strategic deals happening in the Indian banking sector, driven by FDI?
I think so. I think you will see more strategic deals happening. Indian banking system is extremely attractive from a foreign investor perspective. A lot will also obviously depend on the regulators and how they, take into account or whether they encourage foreign capital or not. But yes, the attractiveness of the Indian banking system to foreigners is tremendous.
You know, Mr. Nagaraju, go ahead.
No, the only thing while there are some proposals which were actually concluded in the last 1 year, one thing I think will increase FDI into the banking sector is increasing the FDI limits into PSBs.
Exactly. You preempted my question.
I know that you're going to ask. So I think that's one we have to do this. If you do this, there are two benefits to the country. One, the banks, public sector banks will get more capital, which they can actually provide credit. The second, the valuation of our banks also will go up. And then investors also will make money. So that's a win-win situation for everybody in the country if you are able to increase FDI into public sector banks.
But may I ask you, sir, this was also under active consideration when you and I last spoke exactly this time at the Banking Transformation Summit. What happened to that?
I hope everything will happen together.
Everything, a package deal.
I'm very positive.
Package deal. Huh? A package deal. But when do you have a time?
I think probably the banking committee, high-level committee, also is going to look into this.
You know, I know one of the things that, Mr. Nagaraju, you've of course been also championing within government with not that much success is tax, and to ensure that there is no disincentive for people to actually put their money into banks as opposed to elsewhere. Again, any takers for that? Have you been able to convince people on that front?
No, I think my principle is that the saving should not be disincentivized based on instrument. People should be allowed to save, either mutual fund or bank deposits or any other form. And one instrument should not be taxed higher than the other instrument. Tax neutrality should be maintained. Now, that way, the bank deposit is a disincentivized. Let us hope this issue is being discussed. I hope the government will consider, because increasing bank deposit is crucial for financing the higher growth that we have set for ourselves. That is very important.
Mr. Mistry, since we're talking about the future, sir, regulatory risk, how much of a factor is that for the financial services sector? Do you believe that that is a crucial aspect that needs to be addressed at this point in time, or do you believe that, the foundations have been set?
I think the foundations have been set. Some changes here and there can be made. I can just give you one example. There is, when you're looking at the banking stocks in the stock market, there is this MSCI index. And a lot of passive money is today coming through the MSCI index rather than through active investment. Now, there is a foreign ownership limit in banks of 74%.
Yes.
Which is really just a maximum number. It really doesn't mean much because everything is regulated very, very closely. You can't buy more than 5% shares in a bank, or in certain cases can go up to 10%. So everything is regulated. Now, given that, just simply increasing that FDI limit, that limit, foreign ownership limit, from 74 to 100 could, I'm sure the broker can calculate the number, but can bring in a reasonably large sum of money into India by way of passive funds.
Yeah, and that's a good point that you make, because you're saying that the RBI is anyway controlling the rest of it, so it doesn't really matter whether you go from 74 to 100. I can't help, sir, but ask you, HDFC Bank, the CEO reappointment, how soon are we likely to hear news on that front?
I'm sure you will hear something very, very soon. Thank you.
Yeah, something very, very soon. I get what you're saying. Let me end by asking the two of you, what has been, in your assessment, in your view, Mr. Nagaraju, and you've overseen 2 years as DFS Secretary, where we've seen record profitability for public sector banks and the lowest GNPAs. What, to your mind, has been the big story for you? What are you proudest of?
I'm very proud that banks have done very well. And we brought down the net NPAs, increased PCR, and we made more profits. And we also paid dividends. All our PSB banks, we have paid dividends. In fact, last year, all the government financial institutions made profit. And if you look at it, our credit growth was last year one of the highest. Our MSME growth is very high, including our agriculture. And some things which is not very encouraging industry, we also started picking up. Now, that actually shows the positiveness in the country. People are willing to take risk and bet. And if people are willing to take a risk, the banks are also going to support them and lend them.
Mr. Mistry, same question to you, sir. In the last several decades of being part of this sector, being part of this industry, what are you proudest of?
What did you, sorry?
What are you proudest of? The milestone that you're proudest of achieving?
Milestones for the banking system in India?
And your own personal milestone.
I reached whatever I wanted to reach in life. I don't think I want to do too much more. But for the Indian system, yes, I definitely 100% believe that in the next 5 to 10 years, we will see at least one, maybe two Indian banks in the top 10 banks in the world.
One or two Indian banks in the top 10. In the top 10. That is the perfect note to close this conversation. KK Mistry, Mr. Nagaraju, thank you so much for joining us here this evening. Appreciate your time. And we hope that the ideas that you've put on the table are ideas that the government as well as the regulator and industry take forward. Thank you very much for joining us here. Ladies and gentlemen, a big round of applause.
May I request all of you to stay back on the stage, please. Wonderful and insightful conversation there, and it's now time for a little felicitation that we have for you. All right, before we move ahead, we are taking a moment to recognize and honor two very distinguished leaders for their significant contributions to India's banking and financial services sector. May I request Vishnu Adusat Sahab also to please come, co-founder and managing director, Nucleus Software, to please come on the stage as we begin felicitating our guests. Mr. K.K. Mistry, a veteran of India's banking and financial services sector. He is who brought with him the decades of experience into HDFC, played a very important role in building HDFC Group. And of course, Mr. M. Nagaraju, former Secretary, Department of Financial Services, and it was during his tenure as Secretary, Department of Financial Services that he shaped key financial sector policies and advanced priorities across banking. What an honor to have the two of you here, sir. Thank you, sirs. All right. Thank you, Shireen. From banking, we are now turning to an ecosystem that has been one of the biggest catalysts of India's financial transformation, which is Fintech. Now, India's Fintech journey has been defined by not just innovation, scale, but also the ability to solve for the needs of a very diverse market. And with AI opening up an entirely new frontier, the next generation of Fintech will have to find the right balance between innovation, responsibility, personalization, privacy, speed, and trust. To explore what the next phase could look like, may I invite Ritu Singh from CNBC-TV18 to join us on stage to moderate our next conversation. And joining her on the panel are Anirban Mukherjee, CEO, PayU, Akash Sinha, co-founder and CEO, Cash Free Payments, Miten Sampath, interim CEO, Cred, Sohini Rajola, executive director, NPCI, and Ranveer Singh, chairman and CEO, Kisht. Over to you.
Thank you. Well, what can we say about India's fintech story that hasn't already been said? It's been one of the most extraordinary ones. And we built our digital payments for hundreds of millions of users. UPI is pretty much a global benchmark. Fintechs have moved far beyond payments as well. They're talking about lending, wealth, insurance, financial services, you name it, and giving our banks a run for their money, if I may say so. But the big question, of course, now hinges around sustainability. Now, who pays for this huge infrastructure that has been built, that powers this kind of a growth? The government, of course, has opened the doors to MDR, which is a little fee that merchants will have to, start paying to ensure that this massive UPI ecosystem that we've built continues to live. So, we're here to talk about what that means, whether that makes the system sustainable, and what the next leg of opportunity for scaling fintechs would be. So, again, gentlemen, and Sohini, thank you so much for being with us here. And Sohini, since we're on the topic of UPI, and, we recently just heard from the RBI Deputy Governor that it is very much in your hands, how the whole system gets shaped up, what the fee structure would look like. So just start by giving us a lay of the land. What kind of a fee would make the system sustainable? And, what happens to merchant adoption? Do you expect some resistance to begin with?
Thank you, Ritu. So, while I won't comment on exactly how this is going to shape up, because there is time and there's a process for that, but I think the important thing is to first take a look at how far we've reached, right? Like in July alone, there were about
24 billion.
24 billion, 23.66. Yeah. So we will not round that off since it's in billions, transactions, and nearly 30 lakh crores, again 29.8 lakh crores. Roughly 1 lakh crore is what is being transferred using UPI on a daily basis, right? We are at that scale, one would think that you actually just reached saturation, but it's not true. We have a really long way to go. Like UPI, though it seems ubiquitous to us sitting in this room, we're only about 240 odd daily active customers, 240 million, about 500 million monthly active customers. That is still a very, I would say, much lower than the number of people who have bank accounts, number of people who have access to internet, and number of people who have mobile phones. All the three things that are needed for a digital payment. In fact, I can tell you anecdotally, I have taken an auto in Mumbai where the driver said, I don't have a smartphone, I don't accept UPI, so give me cash. So there is a long way for us to go. There's a lot.
He didn't even use UPI Lite?
No, he didn't. He didn't. And I'm telling you, that's why there is a lot of work for us to be done. Because, you know, when people say UPI penetration, it's very easy. And I think it's the lazy thing to do to say, let's look at tier 3 or, you know, back of beyond or something. No, it's in cities. If you take the gender diversity there, you will find that there are more women who need to be on UPI. So there's a lot of work for us to do on getting the basics right, and then marry that with what is required in terms of dealing with the new cybersecurity, the new innovative use cases. We need to get to agentic. Like there's that whole spectrum that needs to be covered.
That's
so
a very
there's a lot of
interesting
work.
insight that, you know, even the urban metros are not saturated and there's more work to be done there. You know, but for all of those that seem to have a bit of a resistance to the idea of a fee coming onto UPI, just give the audience a sense of what the cost of running an ecosystem that is supporting those kind of transactions is, and whether, let us assume that transactions above 2,000 only are charged this fee. Is that enough, being just 2 to 4%, I think, of overall transaction volumes? Is that enough to keep the system alive?
See, I think, again, it's important to frame this right, Ritu. This is, and this is a life cycle of the entire, you know, where we have come to in terms of fintech and the digital transactions. There's a time period for everything. There was a time when you needed to get to, UPI is only about 10 years old. By the way, it's exactly 10 years old. So if you were in 2015, there was no UPI. And 2015 is not that long ago, right? So there's the scale that we have reached. The investments have not come from any single constituent or one part, right? There's fintechs, there's banks, there's technology providers, there's obviously NPCI. The regulators played a big part. So there's this whole ecosystem, and the people and the merchants have trusted. Like the DG in his speech this morning, you know, earlier when in the start of this program was talking about how the customer doesn't think about what all is happening when all of those digital payments are happening, right? The billions that are happening. So all of this has come together. It's not one individual. It's too simplistic to carve out to say, is this equal to the cost? There is this whole thing of saying, we've come this far, this is what has happened, now what does it take for us to go from
Well, Soni, let's say the Payment Council of India puts the number at 20,000 crores a year. Do you have a number?
No, we do not have a number. I think there are different entities who can come up with different numbers.
And an MDR that would make it sustainable. Is it 30 basis points? Is it 50 basis points? What will help?
Ritu, I think we can, you know, we can talk about this till the cows come home.
Oh, well.
So I think we will
It looks
move
like
on
we
from
shall, but Anirban, let me quickly come to you since you look at this from a payments point of view as well. I mean, for someone like you, does this create an interesting paradox? You can simply choose to shift the customer away from UPI or the merchant in this case to maybe card if there's a fee and there's some hesitation to it? Or do you think merchants would think of it as, you know, the cost of doing business and move on?
Look, there is always an adoption curve. There's always a conversation to be had. But even if you take the largest of e-commerce merchants and we serve them, take a guess at what is cash on delivery today.
The bulk of your transactions? The bulk of the payments go into cash on delivery,
Yes.
I know, but I don't know what the number is.
Yes, it's about 30%. In many cases, it's north of 30%. After all of our efforts, that costs a lot of money. In some cases, it costs a merchant 400 basis points, right? Because with COD comes higher returns, higher frauds, lots of things. So when you just think of even a large merchant who will end up, you know, paying for this, there is benefit, first order direct benefit for them. And then there is massive second order benefits for the whole system, right? I think India is 30%, 35% digitized, much more to go, especially when you think of B2B payments. If you think of all kinds of payments, as Sohini said, we are year 10 of a very long journey. It's a very long test series. We are in innings 2, maybe. Right? So from that perspective, some amount of revenues in the system that helps make up for the charges, that helps make up for the costs, for the significant more investments, I think it goes around in everybody's case. And if the whole country is digitized, we'll actually grow much faster as an economy.
Well, Akash, do you have a number that you think would make it sustainable? Because you, again, interact with merchants on a daily basis. And also this interesting question that some people seem to be bringing up, because we're a Jagaru nation, right? So if you say 2,000 is the cap, will you split the bill into 1,999 and the rest to avoid it? I'm just saying there's a way around it. So what are you hearing from merchants on this?
See, we serve largely online merchants, right? And for them, I think it's difficult to do what you suggested. See, for online merchants, converting a customer to a purchase, it's a costly affair even today, right? So just adding cost from UPI is not going to change the math for them, right? And plus, they already factor in the cost of payment by cards in their business model even today. Right? I mean, they assume, a bunch of the customers pay by card. So again, they're not changing the price basis the payment method, right? Which means they are ready to accept, the cost of payments through the payment methods like credit card, debit card. They're still priced much higher than what UPI is today, right? So for those merchants, again, I'm not trying to be, too opportunistic. For those merchants already factored in, right? I think for UPI, obviously, they pay lesser, but it's already factored in the business model, right? I don't think it will change a lot of behavior for them. Right,
okay, that's encouraging to know if you think merchants will move on. Ranveer, what does it mean for a digital lender like you? Does it unintentionally tend to benefit you since it makes one form of payment, one form of collection a tad more expensive?
First of all, I should rather humbly admit, when already everybody else has spoken, there's only so much I can add intelligently. But given this lacuna, still let me attempt. See, I think it is making a huge difference. At the end of the day, we are a digital lending company, and so is many other people. The moment you have a form factor where you are easy to repay loan, not only easy to repay loan, but get into the UPI autopay kind of an arrangement, that makes a world of difference. So much so, not only true for me, but many other players, the difference between NASH and UPI autopay has, the swing of the pendulum has completely on the side of UPI autopay. So I think it's a very, very, important step from a repayment standpoint. I don't think the MDR coming in there is going to make any significant impact. I think the simple rules of lending, which is to always assess a high-quality customers, differentiate between, rank order the risk, I think those will be far more overpowering considerations vis-a-vis this one.
All right, take that point. Mitheen, since you're the one perhaps on this panel that serves only the affluent customer, so the one that probably will be impacted more than the rest, what's your take on the whole thing?
I mean, I'll just, continue what Ranveer said. I think most of my co-panelists have made all the right points. I don't think there's any, I don't think the affluent customer or the customers that we serve are going to be very concerned about this. I think they're going to be generally happy that the UPI, as Sohini said, wherever they go, they want to pay in the most simple and low friction method. So if more and more transactions get digitized, that's always a good thing. And affluent users prefer that. They prefer swift, smooth, safe, and secure payments. So I think it's a good thing overall for the whole ecosystem.
Well, okay, that's about the MDR, but the fintech story is way larger than just some fees and UPI. So, Mitheen, let me ask you about this whole bunch of new products you're launching by the day. I mean, people keep questioning, what does cred really make money on? But give us a sense of how you're using artificial intelligence. I mean, for banks, it seems to be almost a checkbox exercise to begin with. It's the customer care that's being taken care of by agentic AI. What are you seeing at Cred that is making the most amount of difference?
Thank you for that question, Ritu. So for us, I think there are three broad dimensions we're thinking about. First is internal productivity. I think the pace at which we are able to produce new features, new products, and put them out in front of our customers has rapidly increased. With the same size of engineering team, we're able to put stuff out in a much faster way. You're seeing that with stuff that we launched yesterday and even more. So that's a very big upside. And eventually, we think about that in a manner to say, how can we serve our customers faster? Can we solve more problems for them at lower costs? So that makes a huge difference. The second is all the usual stuff that you mentioned, which is, can we make a customer experience on support a lot more intuitive. A lot of times, the challenge is to try to get to what the customer is trying to tell you, right? And it takes a lot of conversation. And with AI, that's become much, much better. And I think the third is trying to experiment eventually with the user experience itself. And I think there are two areas where we are seeing this happen, which is, financial transactions in general are probably the most complex that a customer generally has to deal with. So the range of how they might think about the problem and how you might sort of interpret is very wide. So we are seeing a large impact on the way in which customers are interacting with their credit scores. And that's really changed in a very big way. And so on the credit product now, you can ask a wide range of queries related to your credit score. And we are seeing that both customer satisfaction on that understanding and the next steps around that are changing.
But would you be able to pin down a certain percentage or some sort of efficiency meter to say the customer conversion or the customer retention has improved thanks to what you're doing with AI?
Look, the CSAT for all of our customer support has shot up by sort of 15 to 20 basis points, 15, 20%.
15 to 20% increase in customer...
CSAT, our customer satisfaction on support has gone up by that much. The number of things we're able to do using AI, I think we're doing 3 to 4x than we were doing before.
All right, that's quite something. Ranveer, I wanted to ask you, has it come to a stage where you can completely trust AI to make the digital lending decision without any human involvement at this stage?
So first of all, I should say AI is making a huge impact. Needless to say, I may not be, sharing a state secret if I say that. I think the difference has to be drawn between in traditional lending. The key question was a deceptively simple one, which is whether the customer will repay or not. While with AI, you are able to ask much richer set of questions. These questions are, in what circumstances the customer is going to pay? What is, are you able to pick signals before something deteriorates? Are you customers who have paid? Not only that, even to the extreme of saying what is going to be the probability of default tomorrow, as against, laying for many, many other things. So I think the vast potential of AI is just beginning to touch us. There's a big, impact it has to be created as we go along. But dare I say that one should not be suspicious of false precision which an AI can give. Because, billions of data used can produce nonsense in a very magnificent manner. So one should exercise that caution. But talking about is machine taking a decision and is AI helping, take that decision better? The answer is a resounding yes.
All right. Okay, but not completely without any kind of human intervention whatsoever.
I think industry has already moved. In phase one of fintech revolution, I would say people where the machine was taking a decision, no human intervention required. People like me, people like Cred, people like other, there is zilch intervention required. But I think, that revolution is complete. Nobody is going to get a medal today for doing an instant loan without, individual.
Well,
everybody has...
certainly none of the fintechs, because that's very much their bread and butter. But Anirban and Akash, this question to both of you. How the economics of your business are changing thanks to AI today? Akash, starting with you.
See, I think we are using AI in a more opportunistic way. Instead of, saving our cost, we're trying to find ways where we can deliver value to our merchants, See, there are two purposes we chase. One is how do we reduce their cost of doing business? Other is how do we help them grow faster or be enabler? And the second part, right, we still see a lot of younger business SMBs, right? They don't have ability to get into, multiple tasks. They only focus about very core tasks, right? As a payments provider, we believe there are a bunch of other activities which they can delegate to us. For example, right, there's one problem we are working is more about, people abandoning the cart. A lot of companies historically have hired people in the call center. They call the customer back. And they try to understand why did you fail, something went wrong with the payments. And we believe a lot of these works could be delegated to our platform, right? So we are coming with more like a agent, super agent setup, where you can create an agent for certain specific task. That way, SMB can do similar kind of activities which a very large enterprise can do, right? Like today, a large enterprise will have people, resources, processes, and they can do more tasks. SMBs cannot, right? They can only prioritize very code activities.
Yeah.
So we can bring, up to the curve, right? We can take away the jobs. Again, we are not putting people to do the jobs, right? And that's where the power of AI is real, right? It's helping you do more with a lesser resources, right? That's the true, we believe, is the outcome of using AI in any of the processes.
Anirban.
Akash said two things, both of that. Of course, more productivity and help SMBs more. I have two other things, right? I think AI will fundamentally reduce the cost of software dramatically, makes much more software available for the micro SMBs in a very meaningful manner, in ways that is unimaginable today, right? India is the land where supply always drives demand. And I think you'll actually see much more digitization and much more faster digitization of SMBs, but many more micro entrepreneurs coming in. Just any tool we release, any software we release, which is virtually free, I'm just amazed at the adoption in SMBs. The other thing that is happening is this intersection of payments and credit. Yeah. Right? We have a credit company as well, and we are completely focused on embedded finance. And SMB, right? What you could do just with structured data, you could do much more with structured plus unstructured data at the intersection of payments. So payments leading to credit, UPI then driving digital credit into SMBs. I think that's also a very macro theme. Yeah. Those are two additional things.
All right. Well, Sohini, I think the last time we spoke on this banking transformation panel, we spoke about what next from NPCI, and there were talks about, ULI, the Unified Lending Interface, credit on UPI. But since then, which has been a 2-3 year period, not much has picked up on both of those ends. If you could give us an update on what's happening, how soon do we see ULI, credit on UPI, what seems to be the friction, if any, and how quickly is it expected to grow?
So I'll talk about credit line on UPI, or credit on UPI more specifically, because that's the one we are driving. I think at NPCI, we thought this would pick up a lot faster than it has picked up. But I think from last year, I would say the volume that was being done on credit on UPI, so someone who gets credit, links their credit instrument, not just links their loan on UPI, and then uses it at a point of sale. What we were doing in a year last year, or what we did in the entire 25-26 financial year, now roughly half of that, or actually that same amount will be done in a month in the next 2-3 months, by the end of next quarter. But it's on such a small base. So just to put numbers in perspective, for example, for the entire last year, for all the people who linked a credit, either a loan or a OD, or any other kind of instrument, and instead of using their bank account to pay on UPI, were using this linked loan account, the total amount was in the range of about 1,000 crores. Now we're doing 500 crores a month. It should actually be tens of thousands of crores a month, because I think that is really again, goes back to what we've been speaking about in this forum, to say, you have to be able to have people, one, offer credit based on the flow and the information and the rich data that is available. Secondly, when the customers are able to link this credit on UPI, then the lender gets better discoverability, better visibility of where the credit is being used, and through autopay that I think you mentioned was about better ability to, or lower the cost of recovery. The same thing for the customer, it is much easier because all the customers who are right now not using UPI may not be just because they do not know UPI, but maybe because they are waiting for the credit. It's not like they have the amount in their bank account to be able to then link it. And the interesting thing there is how both the government and the Reserve Bank has been helping with pushing that further. So many of the government schemes, like the Kisan credit card or the Mudra loan, etc., now are being linked. In fact, a large number of PSU banks are also now picking this up as saying this is one way to be able to get UPI and digitization faster across.
But what about ULI?
So ULI, I think, is something which is being driven by RBIH. So I don't have much context on ULI, so I'll not be able to
let me
comment
ask
on
you
that.
another interesting development, if not slightly unrelated, is the entry of Apple Pay in India. The rumored entry of Apple Pay in India it caused quite the buzz, but it seems that they're entering India without UPI. They're not going to be available because of some regulatory issue with NPCI yet. If you could give us an update on what really is happening there, because people would like to know, and what the entry of a player like UPI would mean for payments in India.
Yeah. So, we introduced BioAuth on UPI last year. Okay. And interestingly, just in the month of July, there were about more than 800 million transactions. Now, 800 million sounds a lot. It's only about 3.5% of the total UPI transactions. So but 800 million transactions, and I'd urge everybody, if you haven't yet done it, go and activate BioAuth on your UPI.
Biometric authorization.
The biometric authentication.
It's the favorite feature on the Cred UPI product.
And by the way, it increases the approval rate by 2% on a very high approval rate already. I think it is amongst the instruments with the highest approval rate. So the transaction or the experience on UPI for all customers, regardless of whether you have an Apple phone or not, is actually, I would say, right up there. And it is accessible to everyone. It is interoperable. It is available at scale. So I think
so will we see Apple Pay on UPI perhaps sometime in the future as they enter?
So see, I think the key thing for us is to say the way we want to offer any product or any service, any feature is it has to be available to everybody. It has to be interoperable and it has to be at scale. At NPCI or the way UPI or our digital public infrastructure is built, we cannot go after anything that is creating walled gardens.
All right, message taken. But Mitheen, another, talking about these global players coming to India and that big investment from Meta, that seemed to be quite the watershed moment for Indian fintechs. And of course, an Indian founder, Cred's founder, going on to take that global role. What was the larger takeaway, you think, for the industry from there? A player like that coming in, putting in this kind of confidence capital, and India's fintech story getting recognized on a global scale.
So I think, Ritu, you answered your question. I think it's the fact that, a large global company putting so much trust in an Indian fintech is obviously validation in us and our business model, but also the larger fintech opportunity in India and how fintech companies, all of us on this, in the ecosystem, are making a large change and how that's happening. And I think, as monetization accelerates, I think my sense is that you'll see a lot more capital coming into the fintech sector, which was not happening for the last little while. So I think that's a good validation for all of us.
But, beyond the validation, I mean, how did the whole thing transpire? Anything more you'd like to tell us about, how you at Cred perceived it and this big change coming in as well, with your founder moving on?
No, I think we're very excited about this because I think, ultimately we think fundamentally about what is the problem that we're solving for our customers. And I'll tell you something very fundamental. One of the core beliefs that we have at Cred is that your track record is an asset. And we believe that the most trustworthy and creditworthy customers in India have not been paid back for that. Right? If you think about one of the big impacts I think about from AI is that credit should be a lot more personalized, right? So the people who are paying their bills on time, they should be treated better and differently, and their cost should come down. And they are treated the same way as someone with a thin file, and that kind of doesn't make much sense. So I think this capital gives us a lot more sort of firepower to go do that. We're kind of excited from that lens.
Well, and we wait to see what you do from there. But I'm being told I have to wrap up here. So very quickly, closing comments from you, maybe perhaps in a line or so. Starting with you, Ranveer. What about the fintech industry do you think is most underrated? And what is the one trend that is most overhyped today?
I think the fintech's ability to follow a velocity, go after narrow segments with almost obsessiveness around, in a very granular manner, I think is very, very underrated, extremely underrated. I think slightly overrated, don't mind me saying that, is because the availability of capital, because at the end of the day, the capital is in a different pool. And we all know the pitfalls of, having large capital but having a very mediocre underwriting can be, remarkably inefficient, while the reverse can also have a limited this thing.
Anirban.
I think the population scale platforms India FinTech has built at the prices, at the costs at which we offer them is just, I don't think anybody else in the world has done this.
So that's the most underrated. What is the most?
Yes.
Yeah. What's the most overrated trend?
Yeah, I think the flow of capital, right? It's just a very hyped up story.
Akash.
See, I think fintechs in India is still, I'd say, not that large. It's still nascent for the size of country we have, right? So we're still in the early days of fintech. There's no point saying there's saturation or overrated, right?
All right.
The more we should speak about fintech, it's better for the people and the country in general.
Oh, I think we talked plenty about fintechs, but Mitheen.
Look, I think just as we are asking that how many Indian banks are going to be in the top 10, we have to ask the same question, how many Indian fintechs are going to be in the top 10?
Yeah.
And I think we should aim for at least 3 or 4.
Well, that's, I'll leave the regulator to answer that last bit of it. What do you think?
The regulator is Reserve Bank of India. So I think the fact that we have all of these transactions and all of this information and the AI capability and the brilliant engineers and everybody, but we still have people who have to actually, go to informal markets, or you have these boards saying, convert credit card to cash, which you can find even in Mumbai. I think that is the opportunity. So whether you call it underrated or overrated, with all of this, what is the impact that we are creating with all the digitization and the digital payments?
Well, fair enough on that note, and hopefully see a fintech in the world's top 10 countries. Why just banks? On that optimistic note, ladies and gentlemen, thank you very much for joining us here. It's been a fantastic panel, and thank you all for listening in. Thank you.
Thank you, Ritu. Thank you to all our panelists. Can we have a photo op? Where is the camera person? Oh, there. All right, gentlemen, ladies. Thank you. Thank you so much. Yes, Ritu, you will be invited back on stage. So we have spoken about the possibilities that AI and emerging technologies are creating across banking and fintech. But now we are turning those possibilities into real-world outcomes. And what it requires is the right technology foundation, one that can combine intelligence with scale, agility, security, and resilience. And our next conversation looks at just that. For a spotlight interview titled Building the Intelligent Banking Stack, please join me in welcoming a leader who has been closely associated with the evolution of technology-led transformation in financial services, none other than Mr. Vishnu Ardasad, co-founder and managing director, Nucleus Software. And to take this conversation forward, may I have Ritu back on the stage.
Well, thank you very much, and thank you, Mr. Dasad, for joining us here on CNBC-TV18.
My pleasure.
Well, we just wanted to understand how fundamentally the way banks operate is changing to your mind from what you've seen it evolve from, those written ledger account, digital bank branching to, this phase of digitization to now the use of artificial intelligence. What to your mind has been the most tectonic shift in the way banks are operating thanks to AI?
I think we have, over the last 40 years, we have seen at least 3 waves. The first one was creating system of record, when we were automating the banking for the first time.
Yeah.
That was followed by another wave, which was internet wave, we can call it. And that's where we tried and created the access, which was further accentuated through mobility. And now what we get to see is automation of decision-making itself. As we've seen in the earlier panel, at least the fintechs have started taking those decisions without any hesitation. And there is no reason why the more cautious banking industry would also not be able to start taking those kind of decisions if they are not taking already.
Well, but where would you pinpoint and say AI has made the biggest difference in banking? I mean, is it simply improving the customer experience? Is it the economics of functioning? Is it financial inclusion? Where, to your mind, has AI so far had the largest impact?
I think impact of AI on financial inclusion is still to happen. We should see that happening over a year or two, where we would be able to reach out to the junior most or the remotest borrowers who would have never ever imagined about being able to borrow at a reasonable rate. So those are the things that we can visualize happening over a year, maybe 2 years, at the most 3 years.
Okay, 2 to 3 years, maybe we'll, and amen to that. But given that you work with, all of these banks and these fintechs and these NBFCs, are they doing enough in the area of cybersecurity, fraud control, thanks to the use of AI than they should be? Because, as the use of AI increases, so do all these risks associated with it. Do you think they're doing enough?
I would say cybersecurity, yes. Because otherwise you won't be able to survive. And of course, there are new threats getting created every minute, every second.
Yeah.
So everyone has to keep up to that, literally on second-to-second basis. When it comes to, leveraging AI for the credit rating and so on, that is an area where there is still some hesitation, still some validation to be done, still some proof of concepts that are happening, and followed by that, I think we can visualize this leveraging in a big way. Coming to fraud, I think there is a lot that is required to be done. We are still talking about upwards of 1 lakh crores of rupees of fraud happening.
Yeah.
RBI has taken certain steps. The Government of India is also very, very keen that this number starts coming down soon enough. And usage of AI in this particular area is something that we should be able to start seeing in next 3 months, 6 months.
Yeah.
And that's where we will be able to
But, Mr.
bring it under control.
since you have this room full of bankers listening in attention to you, as they prepare their tech budgets, what would you say should be the top priorities they should look at in order of preference?
I think clearly the fraud has to be number one priority. I would say fraud and cybersecurity together should be number one priority, because these are the areas which are very core to the trust that we want to ensure in the banking system, in our financial ecosystem. And that is followed by the financial inclusion. That's how I would like to put it.
All right. In the previous panel, we were just speaking to one of the lenders about to what extent, they're allowing AI to make credit decisions, and where does human involvement really come in? What's your take on the whole thing? Is there an area of this credit decision, disbursement, assessment, underwriting, where you can't really do away with human involvement just yet?
I would like to say underwriting is an area where you would need a far greater governance, because you cannot deny credit to someone who deserves it. For example, someone was mentioning to me, a CEO of a housing finance company. Someone in Hyderabad was looking for he got a lottery for a housing lottery, and he was looking for a 5 lakh rupees loan. He's a government servant.
Yeah.
Just 25,000 rupees he earns per month. But 5 lakhs is not too big a number, The only rate at which the credit was available to him was 21%.
25%?
21%.
From a bank?
I mean, bank or non-bank finance company or housing finance company.
Oh, wow.
21%. I mean, when it is available to, someone at 8%.
Home loans as low as 8-10% in good credit cycles.
Exactly. So that is where AI needs to come in and start playing a role, and make sure that this does not happen any longer.
So what, to your mind, putting all of this together, will distinguish between the banks that are able to really harness the technology and move ahead versus the ones that will lag behind because perhaps just remain in the pilot mode? So what are some of the things you think that will distinguish the winners from the losers?
Those of the banks and NBFCs who look at AI only as something that would help save cost. Those are the ones that would not really leverage AI to its fullest. What is important is understanding the power of AI and coming up with ideas and thoughts that would really change both speed of delivery as well as quality of delivery. Using AI, we will need to do things that are have not been done so far. And that is how we will be able to create solutions, create alternatives which are picked up by people really.
Well, speaking of some of the innovations that India has excelled at, of course, payments is one of them. We just heard from NPCI, and UPI is, of course, the story for India to take to the world. But while we saw for payments in a spectacular way, why do you think we've not been able to crack the lending code in the same manner?
I think we should be able to do that over coming next couple of years. The reasons I feel we have not been able to crack ULI to date is our deep understanding of the lending process. We need to understand, lending in a much deeper manner. See, payments are relatively simple. They originate at a place and they terminate at a place, and all that we need to do is they are secured. And both origination and termination are valid accounts. When it comes to lending, there are too many things too many parameters that are involved. And when we understand those parameters of again, what are the parameters based on which you will be able to judge the repayment capacity and the intent, which are very, very difficult to convert into a digital form. So those parameters and the environmental parameters, where does the person who is borrowing, where does she or he live? How does his or her income get affected by environmental factors? How is the environment changing? All these factors have to come in when you look at making a ULI happen. I guess over next 2, 3, 4, 5 years, we would have learned all these factors, put them into a system, and that's when we would be able to make a real ULI happen, which is like UPI is really the need of the country.
But, like payments, do you think fintechs would be able to solve for this faster than some of the legacy banks? Or do you think it's the large banks with their large reach and scale that are better positioned to do this?
I would say both large players as well as small players, as long as the core engine is functional. So we have a core engine functional for UPI. Similar core engine, we'll have to make it functional for ULI. And it's going to be a reasonably complex process. It's not as straight a process as UPI.
Well, since you bring up ULI, I mean, what are some of these tech advancements in the field of finance that bring you the most hope? I mean, ULI is something that's yet to, come into being, to, be put into force. But what are you already seeing on the ground that gives you most hope, for India?
I would say governments and RBI's backing of this kind of process, that alone is good enough it needs to be further backed up by reasonable quality of technology. And now with AI coming in, and reasonably deep understanding of the lending process itself. These two factors put together, we should be able to make ULI happen.
Well, finally, then, let me end by asking you, Mr. Dusad, since everybody's talking about the need to see Indian lenders, Indian banks, and as Miten said, perhaps even Indian fintechs in some of the world's largest top 10, top 20, top 50 banks, what to your mind are some of the things that will help us get there?
I think doing the same thing in a much more efficient way and much more effective way, taking our credit to the remotest corners at some reasonable rates. That is what I would say would help some of our banks get into top 10. I see no reason why we should not be able to get in top 5 also. Because the need continues to be there. It's our systems, our ecosystem that needs to improve.
Yeah.
And some, as I think Deputy Governor also mentioned, some more risk taking from the banking industry. Just the way NBFCs are taking more risk, the banking industry needs to take more risk, and that's how they will be able to grow at rates which are more than 18%.
Is that going to be your final message to the audience here today? Be bold, take more risks?
No, absolutely, because technology is there to support, and technology would be able to explain them how to further take those bold steps and make things happen.
All right. On that very optimistic note, Mr. Dusad, thank you very much for joining us here. Pleasure speaking with you. And thank you all for being a wonderful audience. Thank you.
Thank you, Ritu. Thank you, Mr. Dusad. That was one engaging discussion, which is also leading us now to our final panel discussion of the evening. All right, so we now move on and we talk about how NBFCs have long played a very critical role in extending credit to customers, businesses, and markets across India. And today, technology and data are creating opportunities to make that reach even more intelligent and personalized. But as the sector evolves, scale must continue to go hand in hand with resilience, responsibility, and trust. And our final panel brings these priorities together with the topic, NBFC Redrawn, Intelligent by Design, Trusted by Bharat. To moderate this conversation, may I invite Prashant Nair from CNBC-TV18 to join us on stage. And joining him on his panel are Mr. Abhishek Dwivedi, Managing Director and CEO, Navi FinServe; Sudipta Roy, Managing Director and CEO, L&T Finance; Abhimanyu Munjal, Managing Director and CEO, Hero FinCorp; Jairam Sridharan, Managing Director and CEO, Parimal Finance; and of course, Prashant's here to take this forward. Over to you.
Thank you, Mugdha, for that. You know, we've heard from the banks, we've heard from the fintechs, and I was just thinking when I was down there that, if we were to use like military terminology, banks are like the heavy fighters, right? I mean, the armored divisions and whatnot. I mean, whatever, aircraft carriers, etc. Fintechs are like the snipers, and NBFCs are like the light armored division, if I can call it, but they're not light. I mean, they're huge. It's a big sector. As I think Sudipta was telling us earlier before the panel started, that if you look at new to credit, I mean, I think NBFCs are right up there in terms of getting customers to these lending platforms for the first time. So extremely important, despite the size, and we've got two NBFCs here who are listed, two which are unlisted. and all of them have done phenomenally well. So I think, and of course, I mean, on the panel here, we're also known to occasionally make headlines or two. I think Jairam a couple of years ago talked about unsecured credit being a big problem area. And a couple of, I think about a month later, we had those regulations from the Reserve Bank which came through. So we'll see what we get today. But it's a pretty diverse set. We are covering mortgages, LAP, we're covering two-wheelers, consumer, and of course, I mean, L&T Finance, which of course is, retail, pretty much all segments out there. I want to start with, of course, a regulatory point. First of all, gentlemen, thanks very much, all of you, for being here on this panel. Jairam, start with what is top of mind, which is the Reserve Bank of India circular, the draft circular with regards to revolving credit. How big is it? I mean, of course, we don't know if this will go through in this current shape or form it's being put out. But one reading and one feedback that I've got is that it's pretty sweeping if it were to go through like it is being put out. Your sense?
Thank you for having me, Prashant. My answer to you would have been very different 15 minutes ago. But I met Lata offline, and she tells me that she did some interview recently, which I have not seen, in which she claims that there has been some clear indication that the intent behind the circular is not to be very disruptive, but to just clarify procedurally how things are supposed to go. Now, I have not seen it, but I hope she's right.
I think Lata wanted to do a story tomorrow. Yeah. I think you've given the scoop out one evening earlier.
No, we just heard from a deputy governor.
Oh, all right, you just said it? Okay, all right. I didn't hear it. So clearly I missed something. So, see, in original form, when we first saw the circular, थोड़े तोते उड़ गए हमारे कि यार ये क्या है? So it's a part of the business which has, I don't think, caused any particular challenge. It hasn't really driven any particular problem in the industry. It has largely been targeted at a segment which clearly needs that value proposition, etc. So I really hope that the way the industry first read the circular is incorrect, and the interpretation that I'm hearing now is the correct one, that it is supposed to be clarificatory in nature with respect to definition of businesses and processes. But if it were read in its original form or to the letter, it would be very disruptive to a lot of products and that target the MSME segment, and products which are perfectly safe, like loan against shares, etc. Very hard to see what the difference is in terms of overall risk and why you would want to kind of shut that down. So a lot has happened, it looks like, that I have clearly missed in the market, but feeling a lot better now after having heard this than I was feeling 15 minutes ago, honestly.
For the audience, and I'm sure everyone is well aware, the circular that we are referring to, we're talking about, is basically the RBI saying that, I mean, for products for which companies, which finance companies, lenders put out and give customers, NBFCs cannot have a OD-like product, which is, I mean, you set out a limit, you borrow some, you repay, you keep borrowing, you keep repaying. That is not possible. That is essentially the circular we're talking about. Just one quick thing, Jairam, on for NBFCs, wasn't it always the case that you had to have a defined kind of limit, defined duration? It was always the case, right? So how is what the RBI is now saying inconsistent? Actually, you could argue that it is consistent, and what was happening till now was inconsistent.
Okay, now you're going to get me in trouble. See, there is a letter of what revolving credit means and what term loans mean. In general, everything that NBFCs are doing sticks to the letter of being term loans and not revolving credit. However, there is a broader way you could invoke the spirit of revolving credit, which is that you're not underwriting the customer again and again, but you're taking the same underwriting and then you are carrying it through renewals, etc. A lot of the ways that products like loan against shares or products like Flexi in personal loans, etc., have been implemented as term loans, right? That's, if you look through how the loan actually shows up to the customer, it does show up as a term loan.
Yeah, the design is like a term loan, but it works like an OD product.
Yeah, so the effect is like some sort of a credit which is available to them on tap. I would not use kind of the technical word revolving credit because it's not meant to be that, but it is kind of an on-tap credit available. Disabling that from a kind of spirit perspective would create shutdown of a lot of products that are out there. It would also disqualify a lot of the areas where investments are going on right now. I saw the previous interview where Ritu was asking Sohini about lending on UPI. All that stuff will go away if NBFCs can't do it, right? So it's important to keep in mind that the broad usage of that language will kill a lot of products that are currently being done.
So you're saying loans against shares, loans against mutual funds, credit on UPI,
Flexi,
of course, personal loans, all those.
Yeah, everything goes. So and a lot of the supply chain type products are, sometimes also set up like that.
Lending against gold digitally, I mean, those kind of things as well?
Exactly. Digital loans which have revolving component. A lot of that stuff goes out. And many of these are sunrise sectors, sunrise products. They're not very big right now, but they are sunrise products. So people like us are all making investments in them. So it would be very disappointing if they were all...
Sudipta, come in here. What is your... I just want to sort of get a quick round on this important topic and then we'll move on.
Just as a little aside, you compared banks and fintechs to different... NBFCs are para-commandos. We go where others fear to go, right? But, joke apart. I think this has got multidimensional impact. This is not an easy thing. Primarily because, it's not only about the flexi loan product, it touches supply chain, it touches inventory funding, it touches, some part of personal loans, derivatives which were there with some of the fintechs, it touches that. And frankly, whether it touches loan against shares, etc., it's a slightly gray area because it's a secured asset on the other side. So frankly, first and foremost thing, I think very cogent interpretation is needed as to what it touches and what it does not touch. I think the Deputy Governor's clarification in the evening gives us a ray of hope. But, the total outstanding that we're talking about is anywhere between, the numbers vary, but I think it's ballpark between 1.5 lakh to 2 lakh crores that have this sort of structure.
Around this, in this form?
Especially done by NBFCs.
So around 2 lakh odd crores from
between
NBFCs.
Between 1.5 to 2 lakhs. You don't have the exact number, but our ballpark is between that number. Now, that's a pretty large number. And the fact is that, again, you talked about UPI on credit, though it's not open for, NBFCs as of now. But the fact is that if this regulation were to apply in its entirety, that goes out of the window, right? So, as I said, it's got multidimensional impact, and as an industry and being a board member of FIDC as well, which is the NBFC SRO body, what we have decided is that we will initiate dialogue. Obviously, we need dialogue with the regulator, and we need to sort of reason through as to, where is the sort of hesitation for opening up this sort of products, because I do not think it's a risk issue. Personally, I do not think it's a risk issue. I think the risk of this sort of products have been administered pretty well. So I guess I think it's a principle issue more than anything else. I think there has to be a dialogue on that principle. And frankly, I do believe that a positive outcome can be found.
Just to I asked Jairam this, is the RBI kind of interpreting the rule as it were to be interpreted, and it was not being interpreted all these years? That is one way to look at it. I mean, I know there's the definition issue, etc., which Jairam also pointed to, but what do you think?
As the governor said, that, in spirit, in principle, NBFCs were not allowed to do revolving products. And what they have done with the guideline is that put that in black and white. So that's what he said, right? But the fact is that what was a implicit understanding for many, many years, a lot of water has flown down the bridge, right? And the fact is that now, see, for example, let's take a small shopkeeper. A small shopkeeper might not have the cash flow wherewithal to take a CC limit or a OD limit from a large bank, right? So he wants a small loan, but with the same structure, right? NBFCs gave them the small loans with the same flexibility and structure. And now this is a large established product offered by many, not only a single NBFC, offered by many NBFCs. So I guess, as I said, this needs to be evaluated, a dialogue needs to happen, and then the regulator obviously will do what it wants to do in its infinite wisdom, and we will follow that.
Fair enough. And you're initiating dialogue, and that perhaps is a process which will sort of lead us to finally what shape and form this takes. But Abhimanyu, your thoughts on this issue? How serious is this for you as a business first, and I mean your thoughts broadly?
So this was coming. While my co-panelists was surprised when it came, but I think the regulator has spoken to us in many different formats, right? I chair the CI-NBFC committee. We've been in closed door with the deputy governor, with the CGM, and this was coming. They have spoken individually, and they've spoken to us in the group that they're not okay with revolving credit. Process-wise, could we have, as a body and as FIDC or as CI, attacked it before this came? Could be yes, but it's hindsight, right? My reading is, from an SME perspective, this does not bar invoice discounting. There is a license of factoring, which RBI has issued, and we are one of the factoring licenses, and we do it we have a decent sized book. So it doesn't discount, it doesn't bar us, because that's a license issued by RBI, right? Which is a revolving credit, which is I'm factoring so that doesn't bar us from there. Trades, it doesn't bar us from there. So I really feel the problem is the derivatives of personal loans, right? Where OD getting converted into EMI after 3-4 years. And it would have, I don't know the numbers here which he's talking about.
1.5 lakh to 2 lakh crores.
Could be bigger, is what I sense. But FIDC would have the number. We've not gone deep onto the number. But this will have a huge ripple impact on those borrowers. Because if those borrowers are used to that line, to really lend into that line to pay other obligations. So a systemic impact, not only on NBFCs, but a larger retail borrower pool, which is a cause of worry. And fortunately, the regulator hears, and if these numbers can be substantiated and that impact can be shown, I think there could be a grandfathering of such stuff. But for us personally at Hero FinCorp, we have a lot of SME, we have a factoring license, we do supply chain, which is invoice-based financing. I don't think we are impacted there. Fortunately, we are not into Flexi OD yet. So
you're saying on the SME, on the business front, perhaps it should not impact, but
that's my reading. Because factoring is a license which RBI gives us.
Okay.
Invoice discounting is against an invoice. So it's really a line which I'm doing various tranches.
Yeah.
So it should not be an impact.
Yeah.
So
let me get Abhishek in. Abhishek, you're doing, your personal unsecured mostly. You started mortgages in a small way right now.
Yeah.
Your thoughts on how, you just heard Abhimanyu paint the picture with regards to exactly that, which is personal, on the personal side. The impact will be felt in the most acute way. Your thoughts?
I believe that initial reaction is fear of unknown. When something new comes up, you don't know how it will be interpreted. As Deputy Governor just pointed us out, probably the aim is to clarify and not to do something else. Honestly, my initial reaction was very different than what Jairam mentioned. There are two things, right? At least my understanding, what we do at Navi, we are largely PL. We always say that every underwriting is a fresh underwriting. So if a customer has come to you, you have given the loan. Now the customer is coming again to you. We do a fresh underwriting like the customer is coming to us first time. It's only that you have more data because he has served loan with you, so you know the customer better. But you assess that customer at that point of time as if you are assessing a fresh customer. That is there. Having said that, I think other ecosystem, if the interpretation would have been the worst possible, what we were thinking, it definitely would have hit that. But I believe that the industry is very resilient. See, ultimately, the point is that if NBFCs continue to lend someone over a period of time, it means they believe in the creditworthiness. And given that the numbers are good, it means that the creditworthiness of the borrowers are actually justified. the process has to be changed a bit to kind of work around this. So yeah.
Sure. But the point is that process and what you're underwriting, I mean, that's not the issue here. I mean, they may be excellent, but the fact is it is essentially what the RBI is saying, well, this is allowed and this is not allowed. And I mean, yeah, I mean, we'll have to wait for finally what the RBI says. These are, of course, draft regulations. Now, let's come to what has been really doing well as far as NBFCs are concerned. It's two areas. It's mortgages and it is gold. And we've addressed, Jairam, gold in the past. So I just want to start by just address those two segments and maybe gold a little bit more, if you can. I mean, you started the gold, you've got into the gold business. It's small, very, very small for you right now. But it's just a sign of things that everybody is there and building out very, very fast. Go on.
See, the market in gold was 4 lakh crores 4 years ago, and nobody cared. Nobody cared to enter into it. Everybody was sitting by the sidelines and saying, okay, whoever is playing can continue playing. Like, doesn't really matter. All of a sudden, over the last 2 years, it has jumped to becoming 21 lakh crores. At 21 lakh crores of AUM, it is a business that I cannot ignore. No large NBFC board is going to allow them to not be in this business. They'll be like, what the hell are you doing? It's the second largest business out there. How can you be, let's say, a upper layer NBFC and not be in that business? So everybody will be there in that business because of the nature of how the business works. It's the only high yield, low credit cost product out there. और कोई product में आपको 18% का interest और आधे टके का risk नहीं मिल रहा है. तो ये एक ही business है, तो सब लोग करेंगे इसको, कोई इसमें दो राय नहीं है, सब करेंगे. Now the question is, what does that mean for the industry? And what are the risks if something goes wrong in this business? What it means for the industry, of course, is that the competitive structure will change. The market structure will change. The more dominant position that a few players have had will probably go away. And this business will start looking like every other lending business in the country, where even the top players have single-digit market share. So much more fragmentation is probably one outcome. Lower yields in general is probably a second outcome. But then the risk side, what happens if gold prices break is an important question. Gold is $4,300 an ounce today. At peak, it was $5,300 an ounce. So it's already corrected about 20%. But it has grown at a CAGR of 13% over the last 10 years. It used to be $1,300 an ounce 10 years ago. So it has grown at a CAGR of 13% over the last 10 years. If instead it had grown just by inflation, which is what the 100-year trajectory has been, that gold rises by global inflation, if that's what happens, then gold can go to half its current price. Right? So,
and what happens then? If that were to happen, anything is possible. I mean,
really bad things happen to incumbents. For challengers, not a whole lot happens. Because for challengers, you don't have a big back book to protect. So you don't really worry about it. You take a little bit of hit and you dust yourself off and move on. But if you're an incumbent who's built a 1 lakh crore book on the back of this price, and then suddenly prices fall by 25 to 50%, there is hell to pay. So the impact is not uniform on everybody. Impact completely depends on how big your back book is, as opposed to what you're doing right now.
And also, I think there are products there where if you are using loans against pledging gold for non-consumption purposes, I mean, that 75% LTV, etc. is, I mean, you can go higher, right?
Yeah.
So then for those kind of players, especially with legacy books built on that, I mean, that particular product, I mean, the risk becomes much higher if gold prices were to fall.
See, if gold prices fall, gold lenders will be in trouble. Like, this is not breaking news, right? It is, of course, going to happen, right? The level of problem will depend on individual practices that different portfolios have had, etc. But the fact that large gold lenders will be in deep trouble if gold loan prices fall 30-35% is like, duh, of course. How can you protect it? Like, when the tide goes out, you'll figure out who's swimming naked.
Absolutely. I want to ask you, Sudipta, not about, of course, I mean, Jairam has said there's no question, and if gold prices were to halve, if you put out the trend for the inflation, etc. But do you think gold loans are helping paper over some stress on the personal loan side? Because they are so easily and abundantly available, and they're so easy to get. You think, I mean, there is that kind of thing also happening, which we're not seeing right now?
Maybe on the margin, but I don't think most of the gold loans, and we entered the business pretty aggressively last year. This year we are opening about 10 branches. Almost 10 branches every week.
Actually, your journey absolutely resembles what Jairam said, because you acquired that company with some 1,300 crores in assets.
Yeah, 1,300 crores in assets. We are opening 10 branches a week.
I think 1,300 crores is going to 4,000 crores now.
Yeah, it's gone to 4,000
in a year.
Yes. So it's grown pretty fast. But again, I don't think it is. Maybe some part it is papering over, but it's very minuscule. Most of the gold loans goes for either retiring high cost of personal debt, money borrowed from family, etc., or it goes into business or income generating activity. It does so, right? And so that's why. And the other thing which you said is that actually LTVs in the new guidelines actually went up. Originally it was 80, it went up to 85. Now it is a signal. It is a signal from RBI and government that, if you want to credit flow in a large section of society that is otherwise credit ineligible, right, this is a surefire way of doing it. And historically, this asset class had got very low loss rates. So it gives the regulator a little bit of confidence to take this call. But what has happened is that if you look at gold prices were at $5,000 odd, corrected to $4,000, now gone back to $4,400. So if you see the 20% correction already has happened. And for us, for example, our average LTVs are about 65 to 66%. So in a way, legacy...
This is on the book or the new?
On the book.
On the book.
On the book.
And the new would be higher, I'm assuming?
New will be probably slightly higher, because the LTVs also have gone up. And a lot of balance transfer also happens. So there is also a lot of round robining within the industry that happens where customers take advantage of when the price goes up. Right? So, but I do believe that, gold prices, will there be a, catastrophic collapse? As long as there's wars, uncertainties, geopolitics, I think gold prices are going to remain at a particular level, and it's generally will have an upward bias. Maybe the speed of the upward bias will go down, but, I don't see a sudden collapse of gold prices. So, the only thing is that, if you are operating on the margin and trying to build your book by treading on that 85% LTV limit most of the time, then fluctuation in gold prices is going to give you trouble with margin calls. Which we saw when actually the prices collapsed from 5,000 to 4,000. We had to do margin calls on some of the customers. And one of the realization that we had is that the margin calls are actually solvable. Customers come and put more collateral. Right? So it is not an insolvable problem. Margin call going into auction is very, very limited. So in a way, this industry has its own inherent safeguards built in, and this industry will grow. But will it grow at 50%? No, it will not. But maybe at 25, 30% growth rate,
and you agree with what Jairam said, which is lower yields, etc., as a consequence of everybody getting in? That's the natural... I mean, it has to happen, right?
If there is, a lot of competition, yields will temper a bit, right? But the fact is that will it go... This is an expensive business to do also. It requires a lot of infra.
So I wanted to ask you, so I've heard attrition, for example, because you find trained people and operate it, it's a hard business to do. I mean, it's as high as 70, 80% in some cases. Is that true?
Some of the legacy players obviously provide the pool to the new players. So some of the legacy players will see higher attrition, right? But the fact is, over a period of time, it'll settle down.
Jairam, hard to get people as you build this out, or no? Expensive,
I hear that there are a couple of really big players out there in the market who are nice talent pools. So, see, as a new player, again, it's the most natural thing for me to do, right? If I'm trying to set up a business, I will look at who does this business really well, and I will tell my team, go hire people from there. Like, I'll give a blank check and say, go hire anybody who can find from there. That's what we are doing. I mean, I know it's a little bit shameless, but that's the way it is. Like, that's how you're going to build a business, right? You're not going to start building from scratch.
We are opening 10 branches a week, right? Now, to get 10 branches a week, people, it might not always be possible to get from the market. So some of our own internal people we are training also and redeploying.
Fair enough. On that question of, on your customer base, are you seeing, I mean, how is asset quality, stress, etc.? What are you seeing broadly? And do you think products like gold, etc., are helping us paper over any stress which may be emerging at the margin?
No, so I can tell you that, we have underwritten a lot of customers for personal loan mostly. But we do see that what kind of loans they're taking out of the market. And gold loan, as expected, is one of the top 3. A huge surge in the number of people who are taking loans, and like Jairam, we were talking about the surge, right? It's huge. And while these guys are in trenches, I can just comment on academically. My sense is that it's all comes to the point that ability to underwrite people where you don't have very formal documents, where you don't have exact kind of, say that your salary is coming or, regularly and stuff like that. Gold becomes one of those aspects, right? I believe that even for personal loan, for example, you're saying there is stress. I don't believe there is a stress. But even for personal loan, the penetration will happen where you are able to find out ways to underwrite people by the data what they have, especially for those people, right? I believe that the surge in gold loan is a part of that. Sure. Yeah.
Jairam, the other one is mortgages, which I said, which is growing phenomenal. Again, it's just like a safe product, 20-year product, paid back in, the loan comes back in 8 years on an average, 8-9 years on an average. Delinquencies are low. All well there? No problems at all?
No, all is not well there.
All is not well.
See, when you say the word mortgages, let's split that up into housing loans and loans against property. Housing loans are just fine, not a whole lot of going on
loans.
there.
I think
No. The thing to focus is loan against property. The MSME lending lab business has been growing at a CAGR industry level of 30+% over multiple years. Pricing has held on and risk has not deteriorated, right? But it has been slowly but steadily inching up. Right, it first started in 2024 with some of the micro lab players actually coming up with results which were a bit of a shocker to people, and then it stopped. It felt like, oh, we have all avoided the problem. Nothing is happening around. And since then, I think the problem is building. I think loan against property over the last 2-3 years, the industry growth is extremely high. And we've all got to step back and kind of think about whether the small businesses in India are indeed growing at that rate that they can absorb this level of capital. And by the way, a lot of the gold conversation that we had before, a lot of it is finding its way into business as well, right? A lot of the gold loan is essentially business loan in disguise, where the guy had a tough conversation with his wife in the bedroom the previous night, right? And they've turned up here. So there is a lot of credit that has gone into MSMEs in recent times through one form factor or the other. LAP is a business I worry about in terms of where it is headed.
Over leverage, too much growth, too fast growth. The underlying business is not growing as fast.
Yeah,
et cetera,
I think it's the too fast. Right, too much, too fast. Growth has happened, and the properties. There is when we had the MLAP problem a few years ago, or a couple of years ago, people realized that selling property is not the easiest thing to do. If somebody has a small
Do you think
shop,
we're approaching a point where perhaps we get into another bit of a credit cycle here?
Don't try to get me to say things that I'm not saying. See,
but you want.
I think
I'm just trying to push you to say things you want to say. So
see, I think the lab business has grown way bigger than I think people realize. And a lot of customers are sitting out there with multi-crore rupee labs, essentially with the mortgage of their shop, basically, behind it. If the business starts doing poorly, then good luck trying to sell the shop to somebody else. So it can really start snowballing, pretty quickly. So if a slowdown happens in small businesses, LAP will really suffer.
For now, it looks like, small businesses are doing, maybe they're doing a little better. Maybe they were slowing down, but earnings, etc. If that's an indication, they seem to be doing.
I think we are all surprised by how well the small businesses are doing and how good risk is looking in the last few months compared to what we would have thought.
Absolutely. Abhimanyu, you want to come in? So you're SMEs in a big way, MSMEs, so all this kind of sort of links to you as well.
Yeah, so I think SMEs today are probably the strongest ever when it comes to balance sheets, and risk is showing it, right? We've not seen SMEs have such strong balance sheets, under-levered, right? So the type of leverage is good. But I think what Jairam makes a very important point on different form factors. getting into loans of SMEs, whether it's gold loan, whether it's used car loans, whether it's loan against car, whether it's loan against property, right? So when we look at balance sheet in isolation, looks amazing, but then there are these individual spokes which are actually feeding into it. So for us, we are very clear. We look at ability to play. So cash flows come before collateral. We are agnostic of collateral, and we put a big focus. Loan against property is a big business for us, and we put a big focus on cash flows, even in home loans. So we do financial underwriting, and secondary is collateral. LTV plays a role, but once you've understood the stability of SME, you understand the cash flows, I don't think they're going. It's changed. About 5 years back, to underwrite a Chola Bhatura shop, you literally had to send someone to count the pattals and he sells. Today with account aggregator, GST, the data public infrastructure I'm sure everyone uses, the data availability that we have has just changed the way we can underwrite this segment. So I'm not worried about this. I think we are much better placed to underwrite. Now, if you make underwriting mistakes, then there is an issue. But earlier, you should be trusting someone to go there. There used to be this program called LIP, Liquid Income Program. Some people still run it, where you send a CA to go to a shop and estimate the income versus data available at GST, data available in banking, data available, and you can make income estimator through analytics today and AI to actually deliver it. So I think SMEs are in a good place, and I believe they will grow sustainably. What I'm worried about, actually, I mean, gold loans, of course, there's a lot of competitive pressure. We are not in gold loan yet, but I guess we'll see where it lands, because I think a lot of people have got into it, and it may go the lap route, like Jairam is saying, because the round robin starts, then it's all about, BTs and yield compression. The highest growth asset class till today is personal loans. Right? It's, I think, growing at about 34, 35% after all the cuts that the Reserve Bank of India have done. They've increased risk weights. People have shut down businesses. Under 50,000 have been shut down. Still growing at 34%. So that is something which is to be watched and seen how that goes.
And I think you went through, I think FY 24, 25, you went through a bit of a cycle. And I think you've dealt with that now in terms of personal two-wheelers, etc. So you've had that experience in that sense. What can go wrong?
Absolutely. So we've shut a few businesses.
Yeah.
Open market personal loan we've shut down. We've transformed our vehicle loan businesses, done a lot of analytics. So I guess it's not a lending business is not easy. You have to have the cycles.
Yeah.
And fortunate I've got the cycle at the right time.
Yeah.
And now we know what not to do.
Yeah.
And what to do and double down on.
Yeah. The clock is showing time's up, but I have to I have so many questions, but we're going to be out of time. So, but I must ask about tech and AI and how all of you are using this. I think you spoke, Abhimanyu, about underwriting and helping all this data kind of sort of, putting all of this together. I'm assuming AI is a big part of it. But is this really changing the game in a big way?
Yeah. So in our business, the first use case, and I'm sure it's for the panel, is customer service. So we cater to about 500,000 customer requests a month. 80% are done through AI bot, vernacular bot, or a AI email without human. 20% exceptional handling, you require physical. But what it unlocked was, earlier my capacity of call center, 1,000, 1,500, was not enough. Today, I can at least hear every customer of mine. And it's really changed the game in customer service, customer experience. So that's something that we have implemented 100%. We're also using AI to read unstructured data for collections. And it's helping us. There's the persistence of an AI bot is unmatched, right? Sure. And collections, you require persistence.
Yeah.
And we have seen an AI bot collect far superior and far faster than human, because one is persistence, second is availability, 365 days, 7 days a week. So those are the two big use cases which are validated, which are running in large scale.
Yeah.
And there are lots of other stuff that we are doing under the hood and going to come out with.
So Dita, you've outlined this in a big way.
Very quick. So we use AI across the organization. We started with credit, moved to service and ops, service and voice, then moved to ops, then moved to business processes, and then governance. We use across. In fact, I asked Lada the question to guess which is the most AI-fied department in my organization. It's legal. Wow. Right? So the fact is that we have already built some, close to 10 plus co-pilots that we are working within in the organization, both in underwriting, in terms of early decision making, collections, everything. Plus voice calls mostly on bot for us, on AI bots. And we are not only piloting with one solution provider, but 4 solution providers, so that we are able to test and do the decision making on which works best. For us, this year, we are taking the hard task of transitioning to what I call an AI native organization. So we have started something called a Citizen AI program, where this year we're going to train 10,000 of our employees to start writing agents of their own. In fact, the whole management committee, my management committee, we spent 3 days in Google just building agents on our own. So now my management committee, everyone can build AI agents.
Wow.
Right? So in a way, we are pushing to create probably the first AI native organization in BFSI. Hopefully, we should be successful.
All the best to you, and I think it's amazing to hear that. Abhishek, if you want to come in, I think data, underwriting,
right.
etc.
So honestly, AI is inevitable. AI is a super intelligent, powerful resource to you, but AI is still a child. And let me tell you why, right? So while we are using AI everywhere, but I'm very, very careful of using AI in underwriting. Because many times AI will take a lot of data, and sometimes they come with a very intelligent sounding answer, which you might think is okay, but it might not be okay, right? So, but a few areas where you can actually experiment out a lot. One data point is that when people have their EMIs due, around 95% of people pay us on time. Remaining 5%, from 95 to 98, it happens without any human involvement, right? So that is, AI is extremely powerful. Like we discussed here, customer service, of course, I mean, most of this are being automated across the organization. That's same true for us also. I think the bigger things we are seeing is that workflow automations, like Sudha is also talking, right? Legal or kind of generating first level of codes. So it increases the velocity of work which you are doing, but extremely critical areas, you still need to be very, very careful about the output which is coming to you, and especially in business lending.
Jairam, how's this transformed for you?
Let me give you one positive anecdote and one kind of note of caution. I won't repeat a lot of the points that were made by the panelists. It's truly transformational, clearly, like it's the next internet. It's underlying everything we are doing. So it goes without saying. One simple anecdote I'll give you, there's a bunch of accounts from a collections perspective that we offer to an AI engine, internal AI engine for kind of, we call it human-free collection, where the bot decides what to do, like whether to call or not call. And after 5 days, it might decide, okay, now I'm going to nudge them with a WhatsApp. And after some days, it might decide I'm going to do a conversational AI bot call, etc., etc. That portfolio, which no human touches, the machine was collecting about 80 crores a month a year ago. Today, the machine collects 1,000 crores a month.
Wow.
1,000 crores a month. It's freaking ridiculous. Like
80 crores last year and 1,000
80 crores last year, 1,000 crores this year. That's how much is happening human-free, right? So everything is being done by AI. It's kind of crazy. The cautionary note that I have is, our first use case was using AI to respond to unstructured email, right? And most of the unstructured email from customers now get responded to by the bot. The bot figures out what the customer is trying to say, picks up the right documents from the right places, sends it back, etc. Everything happens. My anxiety with this is, okay, we have taken 60%, 70% of emails and and asked the machine to actually respond to them. What is the so what of that? Is the so what that I'm going to go fire these 7 girls in my call center who are earning 35,000 rupees a month? I'm going to fire them. They are the only kind of breadwinners in their family. I'm going to let them go because I'm all AI. And instead, I'm going to hire these 2 IIT chaps who have got 7 jobs, and this is the 8th offer that they have. And I'm going to, every month send a check to Sam Altman and Dario Amodei. Like, what the hell is happening? How is this grand for the country? I worry about the impact of this for entry-level jobs And as a parent of kids who are in college, I really worry about where kids find jobs and at the entry level, right? And where does a country like India go in this world? So it is something as leaders we do need to be empathetic towards, that even as we use AI, the power of AI, how do we make sure that we unleash it in the right areas for a young, growth-oriented country like India, where the value might be in unlocking revenue and not as much in firing a lot of people because the stock market loves it.
I think that's such a wonderful way to put it. A round of applause, I think, is well warranted. You know, I have many more questions, but we're completely out of time. But I think, Jairam, so beautifully put, and I hope we go in that direction because I think that is the right direction. Thank you very much, all of you, Jairam, Abhishek, Abhimanyu, and Sudipta for joining us here on the panel. Thank you very much. Thank you for being a wonderful audience. Thank you.
Thank you, gentlemen. Have a quick photo op. Thank you, Prashant, and thank you to all our panelists for closing the day with a very engaging and insightful discussion on the future of NBFCs. And with that, ladies and gentlemen, we have come to the end of the Banking Summit. Across these conversations, one message has clearly stood out today. The next phase of banking transformation will not be defined by technology alone. It will be defined by how responsibly we use it. On behalf of CNBC-TV18, I would like to thank all our distinguished guest speakers and panelists, and a special thank you to Nucleus Software for partnering with us in bringing together this platform and these important conversations. A big thank you to all of you. Enjoy your evening.